Good morning, good afternoon, and good evening, everyone, and welcome to the Summer 2022 IPO Bootcamp. My name is Colin Mahan, and I'm the Director of Programs at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit that's building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. As you may have just seen in the chat, the Nasdaq Center launched a free mentor matching platform for entrepreneurs called Mentor Makers. You can create your own advisory board to guide and inspire you with in-the-moment mentorship from topic experts and professionals dedicated to providing exceptional mentorship to entrepreneurs across all races, industries, and geographies. So find or become a mentor today by using that link in the chat. Quick housekeeping item, we're going to open up for live Q&A at the end of each panel, so please submit your questions for us in the Q&A function at the bottom of your screen throughout the presentation. Now, none of what we do here at the center could be possible without all the amazing support from our sponsors, including Nasdaq, Lehigh University, Bank of the West, KPMG, Wilson Sonsini, Airbnb, Woodruff Sawyer, BPM, and HubSpot. We're humbled and grateful for their contributions. Now, during these still unique times, we're curious on how sentiment is among the entrepreneurs that we work with. So before we get started today, I'm going to launch a few polls. First one, how are you feeling about your business right now? Are you optimistic, surviving, a little anxious, or feeling a little fear? We've been measuring this since the beginning of the pandemic, so hopefully that optimism meter is on the rise, and it looks like it is. I appreciate you participating in this. I'm going to end this poll in one moment and share those results. Looks like optimism's in the lead, but totally understand there's a little bit of survival mode and anxiety out there, a little bit of fear. Hopefully our panels today will help with some of those. The second poll I'm going to launch really quickly is what's keeping you up at night? This not only helps our panelists understand what you are trying to learn today, but also helps us at the center understand what you're looking to learn in the future. So is it finance, sales, marketing, scale, team? We will use this data to inform the next batch of programs that we end up planning. Thank you all. All righty, I'm going to share these results. Well, no surprise there that finance is at the top of the key, but there's a good mix between scale, team, and sales. So thank you for that. And before we get started, let's just take a look at the agenda for the day. So we're going to kick off the program with a market update and overview, then jump on to our first panel, which is preparing for and staying on track for your IPO, followed by a 10-minute break. Then we're going to go into transition to panel 2, where our panelists will share executing your IPO, followed by another break. To round us out, our last session will cover achieving success as a new public company. Please note the same link we'll use for the entire session today, so you can pop in and out if you'd like. So without any further delay, please join me in giving a warm welcome for our first presenter to share the market update. Will is a director at BNP Paribas. Will, welcome.
Thank you, Colin, and thanks everyone at the Nasdaq Center for allowing me to come and give this market update for what I think is either the 4th or 5th time now. So really happy to be on here as always. As Colin mentioned, my name's Will Benish. I'm a director of equity capital markets at BNP Paribas. And some of you may have seen me on these previous market updates. So hello to all old friends that are on here, as well as anyone who's joining for the first time. So I have the challenge today of giving an IPO market update in a market where there's been almost no IPO activity in the last couple of months. So it's an interesting time period for sure. Definitely a challenging time period. But that being said, I'm going to talk a little bit about kind of putting this year's market into context. I want to go ahead and look at what those factors might be to help that would have to happen to help reopen the market. I want to spend some time examining past market downturns and kind of what those post-downturn reopenings look like. So hopefully going into all of that detail is useful and insightful for everyone here, despite the current somewhat challenging environment. So let's go ahead and go to, if we could, Cody, please go to the first page. or I guess the second page after that. Great. So I wanted to start by putting the 2022 year-to-date market into context. And everyone who's been following the news knows that it's been a challenging market. You can look at this top chart here, which looks at IPO volumes going all the way back to 1990. And if you look on the right-hand side of that chart, you'll clearly see it's been a difficult year for sure in terms of IPO volumes. We're at around 4 billion of issuance so far, only 13 deals sized greater than 50 million. And that's, of course, coming off what was the strongest year of all time in 2021, where we saw, not even including SPACs, over 300 deals raising 152 billion of issuance. So that surpassed the record that we'd seen in 1999 and 2000 during the tech bubble, which were records that stood for a long time in terms of volumes, but we really blew past it last year. And if you look at SPACs, which I didn't even include on this page, to try to make it more apples to apples, that's over 100 billion last year as well. So that brings you to over 250 billion of issuance if you include SPACs. So we've gone from that to what's a certainly challenging market. If you look at the bottom left-hand chart now on the page, what I tried to do, since 2021 was clearly an outsized year, I took the 5-year average of years that we, issuance that we saw from 2017 to 2021, and I've compared that to year-to-date issuance month by month. And again, even when you kind of average out the last 5 years, you'll see that the 4 billion that we've seen year to date is still down around 90% from the 5-year average. So clearly a challenging year. There's a lot of factors that have gone into that. I'll touch a little bit more on that in the coming pages. But clearly one of the things that has led to the challenge has been the performance of the deals that came last year, which has been very challenging for investors which participated in those deals. So if you look at the bottom right-hand side of the page here, what we're looking at is, compared to the IPO price, we're looking at the average return of each IPO over the first day of trading, over the first week of trading, over the first month of trading, and then what the price change is from the IPO price to where it's trading today. And you'll see there's 3 bars here on this chart for each time period. We have the 2021 deals. We have, again, that 2017 to 2021 average. And then we have, even though it's a small number, the 2022 year-to-date deals. And you can see that 2021 was pretty much in line with previous years in terms of the early performance over 1 day, 1 week, 1 month. So they generated good short-term returns for investors. But looking long-term, there's a pretty stark difference. The average deal, so if you bought every IPO in 2021, you'd be down 41% on that. So it's kind of a negative alpha generation, certainly for investors who participated in every deal last year, compared to an average of 8% for the last 5 years. If you bought every deal for the last 5 years, certainly that number would have been a lot higher last year, obviously, because the market as a whole has taken a downturn. But the downturn in terms of IPO performance has been even worse than the market as a whole. And I think a lot of that can be chalked up to the types of deals that came to market, and we'll talk more about that on the next page. But a lot of the deals that came to market last year were fast growth companies, whether they were in tech or innovative fast growth companies in sectors outside of tech, sort of high beta stocks that came at high valuations. And now there's been sort of a re-rating in the market. They've seen their stocks fall faster than the rest of the market. So that's been, I think, a big factor in terms of hesitancy of investors to come into new deals this year, has been that performance of those deals last year. Now, for the small number of deals that have come this year, there's been kind of less volatility, both to the upside and the downside. So the average short-term performance was positive, but much more muted compared to the last 5 years. Whereas the performance to date, again, the market as a whole, it's been challenging. So performance to date is lower, but certainly less volatile in terms of that underperformance as compared to 2021. So that's kind of where we are right now. If we could move Cody to the next page. I don't want to spend too much time on this page, but while we're talking about 2021, I did want to kind of go through a few specific deals here. And what I've done on this page is we have the 30 largest deals that came to market last year, again, excluding SPACs. But if you remember, there were over 300 deals. So this is only 30 of the largest deals, and I've ranked them in terms of deal size. But even these 30 deals account for around 67 billion or so in volumes. So we're looking at a significant chunk of the market volume just tied up in these 3 deals. And what I call your attention to kind of on this page, and I know it's a lot of, I know it's certainly a lot of info here, but if you look on the right-hand side of the page, we're looking at the performance of individual deals since IPO. And you'll see that on average, the average return of the top 30 IPOs in deal size last year, the median return is around minus 54%. So it's actually a bit worse than the market as a whole, if you look at just the 30 largest deals. And then 25 of those 30 are actually trading below the IPO price. So 83% of deals trading below the IPO price with a median aftermarket performance of minus 54%. So again, I think it just kind of highlights what that graph on the bottom right-hand side of the last page showed, which is the challenging returns for IPO investors who were major participants in the market last year. Now, if you look at the sector of these 30 largest deals, I mentioned fast-growing tech, high-growth names, and you'll see that the majority of the 30 largest deals were tech deals. And even amongst those deals which are not labeled as tech sector deals, like Rivian, for instance, which is labeled as an auto deal, which was the largest IPO last year. I mean, we all know that's a fast-growing, innovative company, EBITDA negative. Oatly, for example, was another fast-growing kind of EBITDA negative, innovative food and beverage company. You had Oscar, which was insurtech. So even amongst those sectors which weren't necessarily qualified as tech, it was a type of company that was fast-growing, negative EBITDA, loss-making type companies, right? So that kind of gives you a sense of the types of companies that came to market and what their performance has been. So if we could move to the next slide, please, Cody. So clearly times have been challenging, and we touched on that. So I want to kind of move to a little bit more optimistic set of topics to talk about now. So we know it's been a tough start, but now that we know that, what's it going to take for things to get better? And we're in a challenging macro environment, obviously. We're in an environment where people are worried about inflation. People are worried about stagflation. So there's a couple factors, I think, that if in these different categories things start to improve, then that would allow the IPO market to really start to reopen. So I want to touch on, I think, what are 3 important factors here. So the first, of course, is overall market conditions. You generally do need strong overall market conditions to have a strong IPO market. It's very tough to have a good IPO market when you're in a volatile overall equity market, when you're in a volatile geopolitical state, when there's recessionary fears. So we would probably want to see some of these overall market concerns stabilize a little bit. I'm not saying everything has to be like 100% rosy. Inflation's totally gone. We're not worried about a recession anymore. It doesn't have to be 100%, but we need to see some level of improvement. And so one rule of thumb and kind of very back of the envelope metric that folks use in the ECM world is the CBOE volatility index, or the VIX index, which is a general measure of market volatility. And kind of the back of the envelope rule of thumb that we have historically used is a level of 20 for the VIX. So when the VIX is at or below 20 historically, that means that volatility is low enough for the IPO market to be in a healthy state. Now, it's not always true. In 2020, for example, the VIX spiked really high when COVID first came onto the scene, and it took a while to come back down. And if you remember, the second half of 2020 was actually a pretty decent IPO market, even though the VIX was still kind of declining and above the 20 level for most of 2020. So that being said, we want the VIX to get at or below 20. It's hovered kind of in the mid 20s in the last couple of weeks. Maybe it'll get there. It doesn't have to get exactly to 20, but we'd want it to kind of stay in the low to mid 20s for a long period of time without any major spikes. And I think part of the issue when it comes to IPOs and the IPO execution process is that it's not a product that can be executed over an extremely short time frame. Certainly since we've gone post-COVID to sort of a more virtual or hybrid roadshow format versus the physical roadshows that we used to do pre-COVID, the execution process has gotten quicker, but you're still kind of out on the road for 5 or so business days, right? And if investors feel like, I think with the market we're in now, for instance, that there's a chance that one of those 5 days, the market's going to go down 2 or 3%, it's tough to get people to commit to kind of, really take an interest in the IPO and put in orders and feel like on the first couple of days of trading that the market isn't going to tank and kind of, ruin their short-term IPO, post-IPO performance. So I don't think the market necessarily has to be up every day, but I think people want to start to see fewer huge swings day to day, which is reflected in the volatility index, the VIX. So I think that's the first factor. The second one is aftermarket performance, which we already touched on the previous slide. When you have strong aftermarket performance in the IPO market, it does create a virtuous cycle because it's considered a product that can generate alpha for investors. So if the average deal is outperforming the S&P, you're generating alpha, you're creating returns for investors, you're raising the AUM in those investors' funds, and it's a virtuous cycle that allows them to have enthusiasm and come back and participate in more deals, and that propels the market onward. So clearly we've not had that virtuous cycle with in the last few months with the returns that IPOs have had, which are largely negative. So we'd want to start to see a recovery in terms of IPO aftermarket performance. This chart here on the right in the middle of the page, it's left off part of the legend there, but that kind of lime green line that was above the S&P and Nasdaq for a long period of time throughout 2020 and 2021, you can now see it's below the average performance for the S&P and Nasdaq. So we want to see that average performance come back. I think in practice, what that means with the IPO market is we're probably going to start to see, when the market comes back, it's going to be a trickle of deals, I think, at the very start, as like a few issuers kind of dip their toe in the market. But if the first few deals that come perform well and investors experience strong returns from those deals, there's a chance that there could be a huge wave of deals that starts to come after that. So I think people would want to see the first few deals that come to market do well, get a little bit of reassurance for investors, bring up investor confidence, and I think that could be something that could start to open the floodgate, so to speak. And then the final factor is fund flows into equity funds. We saw even kind of before COVID, we were sort of in a period of outflows for equity funds that continued along with the sort of COVID dip in mid 2020. But what we started to see in 2021 was a reversal of that, and it was actually pretty steady inflows into equity funds throughout most of 2021. So this was dry powder that's available for fund managers to kind of put to work when they participate in the IPO market. And that even continued to early 2022 as we started to see sort of geopolitical concerns come into play. The only exception was that kind of in the last batch of fund flows that we have access to, and we don't have the full data for May yet, but in April, we did see a little bit of a reversal of that. So, I think that was because we saw fund flows kind of go negative for all asset classes with inflationary fears and rising interest rates. So it's a little bit tough to predict what the fund flows are going to look like over the next 12 months. If you look at sort of the data as to what's happened during rising interest rate periods, actually during most periods of rising interest rates in the last couple of decades, there's been sort of a positive correlation with rising interest rates in the equity markets. That's because typically when interest rates go up, it's because you have a growing economy that has led to inflationary fears. So that may not hold if we enter sort of a more stagflationary, so to speak, environment. So it's tough to predict what's going to happen, but I think perhaps we could see continued flows in the near term into maybe more value funds as opposed to growth funds. So it's a whole debate that we can have and kind of beyond the scope of today's update, but that's definitely an important metric to continue to watch in terms of the health of the IPO market. And if we're at least fairly flat in terms of fund flows, I think that's supportive along with the other factors if they're there to have a reopening of the market. So if we could move to the next slide, please. So we talked on the last slide about what it would take to reopen the market, but I wanted to kind of go into, okay, the factors are in place to reopen the market. It starts to reopen. But what does that reopening look like? And can we predict the types of companies that are going to be the first ones to come to the market, or the types of companies that investors are going to have high demand for once the market starts to reopen? And so in order to kind of get at this, I did some analysis on the last two major downturns in the IPO market, which were, I've called them here, the 2000 to 2004 period and the 2007 to 2011 period. And what I've done with the top two charts on this page is I've looked at each of those periods and I divided them into half-year periods. And what I tried to do was include kind of the last couple of periods before the downturn really hit, and then look at what the IPO market looked like through that down cycle, and then a couple periods of the recovery on the other side of that cycle. And I didn't include the 2020 downturn because honestly, that didn't last for very long. It was a couple of months and then the IPO market kind of kicked right back off. So it wasn't really an extended kind of downturn period like we saw in the 2000 to 04 and 2007 to 2011 period. So it's interesting, I think, to kind of compare these two periods, that the downturns definitely looked different in each of those periods. And obviously there were different factors in different economic environments in each of those periods. But if you look at the downturn that we're in now, it kind of mirrors aspects of each of those. It's not looking exactly like either one of them. It's sort of a blend, I think, of those two downturns. So in terms of the abruptness of the downturn, it looks kind of like what we saw in the second half of 08 into the first half of 09. There was a pretty abrupt drop in terms of the IPO market and the number of deals. And that's what we've seen here is a very abrupt drop. 2001, probably because the downturn was really focused around tech, and some non-tech deals continue to happen. It wasn't as abrupt. It was sort of a slow burn fall in terms of volumes over a period of several years until we bottomed out in the first half of 03. So in terms of abruptness, we're looking more like 08, 09. But in terms of deal composition and the types of companies that came to market, it actually more mirrors what we saw in the bursting of the tech bubble. And you can see the kind of dark green in the stacked bar in each chart represents tech and telecom deals. And you can see in the tech bubble, obviously they made up the majority of volumes. But in the first and second half of 2021, if not the majority, definitely the plurality of deal volumes were from tech and telecom deals. So it was sort of that similar feeling of a lot of companies that came to market with maybe overextended valuations, a longer route to profitability, cash flow negative. It looks much closer to 2000, the 2000 downturn if you're looking at that factor. Now, if you look at sort of the recovery of the market in 2000 to 04 and 2007 to 2011, even though the downturns themselves look different, the composition of deals during the recovery looks similar in that you saw a clear rotation away from these types of fast growing tech deals into a much broader, more diverse composition of the IPO market. So you can see, like, if you look at 03 to 04, and if you look at 2010, 2011, the vast majority of deals that came were outside the tech and telecom sectors. So it was a more diverse market on the backside of both downturns. I think as investors dipping their toe into the market want to start with deals that feel more stable, are EBITDA positive, steady growth, but not necessarily ultra high growth, and manageable leverage, right? So all of those factors, I think, if you look at the last two downturns, they would suggest that that's maybe what our recovery will look like when it happens. So I put a question mark there on the bottom chart. It's unclear exactly when the recovery is going to happen, but I think when we do see it, the first kind of contingent of deals that come to market, I think it's very likely that it's a more diverse array of sectors, that it's more stable companies, that it's less tech-centric. So let's move to the last page. I won't spend too much time on the last page because we're running near the 12:30 mark. I haven't historically talked a lot about SPACs on the previous updates, but I did just want to point out a couple things about the SPAC market because I think it's interesting. There's a lot of headwinds facing the SPAC market, and we tried to kind of put it all on one page. The left side of the page kind of looks at new issuance, and the right side of the page looks at de-SPACs. And you'll see one interesting thing I just wanted to point out, which I think is interesting, is the top left chart here You can see overall SPAC volumes really dropped off, and I think people knew that. But what I also looked at were kind of the composition of deals being underwritten by what I call the Big 10 underwriters, so like the 10 largest bulge bracket US banks. And the percentage of deals being underwritten by those large Big 10 underwriters has also shrunk. And it's been a pretty steady downturn. So you're seeing an overall drop in the number of deals, but you're also seeing the large names, Goldman, Citi, the ones who really dominated the SPAC market, participate in fewer deals, which I thought was interesting and maybe wasn't on people's radar. And then in terms of aftermarket performance, we talked about how IPO index has underperformed the broader market, but the de-SPAC index, which is kind of putting into a portfolio all of the de-SPACed companies once the business combination is complete, has even further underperformed the IPO index, which I thought was interesting. So I'll leave it there. It's an interesting page. I don't have time to go over every chart on the page, but suffice to say, SPACs were a huge part of the market in 2021. I haven't tended to focus on them because I wanted to focus kind of more on regular way IPOs, but that's a market that's perhaps seen a downturn that's even more severe in certain ways in the IPO market. So I'll leave it there. It's 12:27. Do we have any Q&A? There's a couple. So how do you see IPO opportunities for companies in the renewable or hydrogen sectors? That's an interesting question. So if you look at the pipe, the public IPO pipe, which you can go and look at, these are companies that have publicly filed with the SEC. There's actually a lot of deals in the renewable sector in the pipe, I think, that are just kind of waiting for the market to recover before they go. So you have companies in the public pipes. You can go on the SEC website, so it's all public info. You have companies like Rev Renewables in the pipe, and a few others, which are renewable generation companies. And you had Fluence Energy, which was in the energy storage space, which came last year. So I think it's something that investors will be interested in. I think the overall market conditions need to be broadly need to recover more to support it. And hydrogen specifically, I think that's still pretty nascent in the US. There were actually a couple hydrogen deals that got done in Europe, which are interesting to look at. There was a small deal for a company called Lyfe, Lyfe, which got done in France, which I think was pretty well received. But I think that's something maybe in 2023, I wouldn't be surprised to see, hydrogen deals start to come to market. And by the way, if you look at, I talked a little bit about equity fund flows. If you look at flows into ESG and sort of environmental sector funds, they're amongst US investors, dedicated environmental sector funds, it's not a huge asset class yet, but it's growing much faster in terms of AUM than the market as a whole. So I would add that, and I think that's a trend that we'll continue to see. The other question was, how do you see ECM markets IPO opportunities similar across the US and Europe? Yeah, I mean, that's an interesting question. Tough to answer with 1 minute left here, but I would say that I'd expect it to be fairly correlated. I mean, the European market right now seems to be a little more active. And going back to the renewables side, there was the Italian utility company just also announced that they're carving out the renewables business, which is worth around 8 billion euros. And so that's happening right now. So there's a few more deals, I think, in the market right now, but I don't think it's going to be a huge flood. I think if there's a big reopening, we'll see it both in the US and Europe.
Awesome, Will. Thank you so much for that market update.
Yeah.
Hopefully that optimistic question mark box at the end will happen soon enough. But really appreciate you sharing your time and expertise.
Thank you.
Up next, our expert panels will cover preparing for and staying on track for your IPO. So please join me in giving a warm welcome in the chat to our moderator, Lauren, who's a partner at Wilson Sonsini. We've got Allison, who's a partner at KPMG, and we have Priya, who's a partner and senior vice president at Woodruff Sawyer. Welcome, team. Lauren, over to you.
Thank you so much, Colin. We'll start with introductions. My name is Lauren Liclau. I'm a partner at Wilson Sonsini. We're a leading law firm in the IPO market. We frequently advise high growth companies in the tech and life sciences space on IPOs, other capital raising activities and transactions. I'll hand it over to you, Priya.
Hello, I'm Priya Huskins. I'm a partner at Woodruff Sawyer. We're a full-service commercial insurance brokerage headquartered out of sunny San Francisco, servicing clients worldwide. We do all lines of commercial insurance, including employee benefits, and we are a market leader when it comes to D&O insurance, particularly for IPO companies.
Thanks, Priya. Allison?
Hi, everybody. My name's Allison Barr. I'm a partner at KPMG in our private enterprise practice. I split my time serving our private enterprise clients, both pre-IPO and going through IPOs, as well as serving some of our larger public clients. And I'm happy to be here today.
Thank you. Well, thank you so much for having us here, and thanks everyone for attending. We have an interesting panel today, so excited to talk with you both. So our panel today is on preparing and staying on track for an IPO. So I thought we could start out with discussing, how far in advance of an org meeting should a company begin preparing for an IPO, and what are some specific things that require a lot of lead time and attention. I know when a company starts preparing, there are a lot of things a company needs to think about. Just one is managing multiple work streams while still sort of managing your business. Building out the right team for a public company, corporate governance, and really thinking about your board. There are certain independence requirements under stock exchange and SEC rules for the board and committees. And so Priya, I was wondering if you could weigh in on sort of when a company should start really looking at their board and thinking about recruiting independent directors or any new directors they may need.
Lauren, I love this question because it's a great example of something that if you are planful goes well, and otherwise it can be a complete disaster. What I have seen over time is it just takes longer than folks anticipate to recruit the right board to take you public. And it can be the case that you've got some awkward dynamics. Sometimes the people who got you to this point aren't going to get you to the next point. So it can be a little bit fraught. But as we think about what is the board you need for go forward, the first thing I would always identify is the audit committee chair. And good audit committee chairs take longer to recruit than you think. That goes double if you want a diverse candidate. The other thing about a really good audit committee chair is that he or she will want to be involved in your company, part of your process of scaling up here at this last moment before going public, well before you file your next amended registration statement. And so, I would say easily 18 months. That is not in any way too early to start thinking about what is your public company board going to look like. The good news is you're also recruiting a group of people that hopefully can help take you through this extremely important window. So it's good to spend time on this early.
Is it ever too early to start thinking about this, do you think, given, windows may have shifted or?
Yeah, I do think there's something like too early, right? And part of it has to do with the kind of directors that can be very helpful for you as a younger startup are often not the same people that are good at working with larger companies. So like a lot of things, directors sometimes have their lanes. And so if if going public is a hope and a prayer in the way future, that's probably not the time to recruit your public company ready directors. And so that's part of the process. Another thing is so many companies dual track. Am I really going to go public or do I plan to sell? If you have no visibility on that, you're probably not quite yet ready to start recruiting your public company board members.
Yeah. Great points, Priya. A follow-up to that question, on the insurance piece, when should companies contemplating an IPO get started on the D&O insurance process?
Yeah, so it is there is a confluence of two things. And one is what we just talked about. You're trying to recruit the right board members to take your company public The right board members understand that taking a company public is an inflection point for risk, not just for the company, but for themselves personally, right? Directors sign the registration statement, technically unlimited personal liability, pretty scary. So part of the question of when do we start getting serious about our director and officer liability insurance, that does dovetail nicely to when are we starting to recruit our board, because those board members will naturally need to be offered a very warm and safe blanket of insurance, I would say. But the other part of it is for you as a company, as you're going up the ramp to go public, remember that your private company insurance will be completely rehung when you go public. It's very likely, in fact, that you'll not only change the amount you're buying, usually more, but you'll even change the insurance carriers, and the product itself looks different as well. So my advice is that when you're ideally 18 months or so out, that's when you need to start being very serious about the insurance. Ideally, your broker who's going to do the public company work would actually get one cycle as a private company to start positioning you with the right carriers, with the right narrative, to start talking about the right risk framework. And it's nice to be able to do that, not just as you're going public, but one cycle ahead of time. If you're past that, we can still get it done, but you asked an ideal question, and that would be the ideal answer.
Got it. Thank you. Moving on to kind of, the finance side, I was hoping, Allison, you can weigh in here. I know there's a lot to think about prior to an IPO, including, building out your financial reporting and SEC disclosure functions, starting to act like a public company for a while before going public, including sort of quarterly closes. From an internal controls and financial reporting perspective, what are the key items that companies should prepare for really well in advance of the IPO?
Yeah, a lot of what Priya said related to, recruiting board members kind of resonates with me in terms of this question as well. I think when companies are thinking about scaling up their finance and accounting organization, you need a runway there as well. Right now there's such a war for talent, especially in this finance and accounting, skill set. And the companies I work with have really, had a hard time recruiting for some of those more senior positions. Think, CFOs, corporate controllers, technical accounting people, SEC reporting people, software and SaaS revenue directors, and those types of roles are really in high demand right now. And so, I think that, as companies think about that path to IPO, you really need to kind of map out what are all the positions we're going to want to fill, how am I going to prioritize those, and then, which order am I going to go about trying to recruit each of them? Because the reality is you probably aren't going to recruit them all at once. And so there is, a pretty long runway to get those teams up and running. And depending on the size of the business and the complexity of the business, you might need even more people than you might have originally anticipated in order to be able to do all the things you need to do from a public company financial reporting perspective. So it's really important to kind of have that recognition that you can't do it all at once. It kind of needs to be staggered. So coming up with that prioritization and timeline is important. I think in addition to recruiting, because that's going to be a really important piece, getting the right people in place, it's also about processes and systems. So, what systems are you going to need to have in place so that you can efficiently and effectively be able to close your books and feel really good about, the information that those systems are providing you with, and how can you start the journey of automating as much as possible, so that you really feel good about, the quality of the information you're getting, and the ability to leverage your people so that they're not, manually preparing spreadsheets every quarter or things like that. So there's a lot to think about, and depending on, what type of company it is, you might need a whole lot of different systems that you haven't had before. It's fairly common that when we start working with companies, they might be on something like QuickBooks, right? And then leading up to that IPO, they want to move to a bigger ERP system, a billing system, a CRM, and getting all these systems in place, implemented, and working together. It is not an easy process. So it takes quite some time.
Got it. Sounds like the theme here is planning early. So as a follow-up to these questions, I think just given the current market we're in, it's a much different market than it was a year ago. I think we're talking about planning here, and are there things that a company should still be doing, even if their window may have shifted? Allison, should a company still be kind of putting in place these processes now, or should they wait? Is there any market consideration there?
Yeah, what I've seen is that if a company was on the path to pursuing that IPO, understanding that the market has obviously slowed a great deal, chances are that, if the executives and management are still thinking, hey, we still want to be on that path to IPO at some point, we know that the market slowed now, let's give us the opportunity to be ready when that market opens back up, right? So it really actually gives you some good time if you're in that boat to say, what are the things that I wish I had been able to do before we started this process, maybe several months ago? Is there a hire I want to get? Are there systems I want to implement? Now's the time to do it so that you aren't then trying to do it in conjunction with, getting that S1 on file when the time comes that's appropriate again. So, assuming that you want to kind of keep moving forward with those IPO prospects, I mean, my biggest thing I would encourage is to just keep improving your processes and systems, improving your controls. It's just going to make you that much more ready when the time comes.
Yeah, I mean, I have to say that I certainly have a lot of clients personally that, they've been breathless for 2 years, running so incredibly hard. Nobody wants to see the market go into a prolonged downturn. Taking a little bit of a beat to catch up might actually be a really good idea. Like fixing the plane in flight is super hard. And I think it's a question of cost, right? Because you have opportunity costs and hard costs. And the reality is when things are a little bit slower, you may have more time for implementation, but of course, people don't want to get upside down on the cost of something if in fact they think they're not actually going to be able to go out in a reasonable time. And so, for each advisor, for each consultant, including for insurance, that's going to be one of the questions. What can we do at low or no cost to prepare without actually making the financial expenditure? In the case of D&O insurance, there are two things to think about. And the first is a little bit scary for some of the companies that are in fact going public because they really do need that modality to raise money. And we've seen this in earlier cycles where maybe companies didn't do a bridge round, they're planning to go public, then markets contract, private company money starts to go away as well. And the concern, even from a private company D&O insurance renewal perspective, is what does the balance sheet look like? So I don't mean to sound like, Cassandra and all scary, but if things are being delayed, that balance sheet is important for a lot of reasons, not the least of which, well, probably, I'm not going to say the most important, but certainly one of the issues is, can you in fact get your private company D&O insurance renewed? Or are you one of those companies whose profile is that you actually need to raise that money and now you're in a jam? But for your public company readiness, the news is much better. Remember that the actual starting gun of the D&O insurance process for an IPO is the filing of the confidential registration statement. Before that, your broker will put in place NDAs. Ideally, you're having strategic conversations about what does the program look like? What does the limit look like? What are your board's preferences in terms of personal protection versus corporate balance sheet protection? Those are all conversations you can have without incurring costs. And I think it's a good example broadly of working with your advisors to understand where can you be planful and strategic strategic without necessarily committing to paying something. For D&O insurance, you actually don't pay for the insurance until you go public.
Great. Oh, good point. That's really helpful information. So I wanted to drill down a bit on building out a team. I know we touched on that, but want to talk about who the key hires are really in order to operate as a public company, and how would you think about timing of those now? Maybe Allison, can you provide your perspective here on the specific types of finance roles that you view as key in the lead up to an IPO? And I know you mentioned too, there's a lot of competition for these specific roles, and are you still seeing that?
Yeah, sure. I mean, in terms of key hires, I mean, my thought process is it probably makes sense to always start from the top and then build out the team. So, that the key hire, number one, is probably who is going to be that CFO who can take you public. That might be the person who's already at the company, but it might not, and I think you have to take a look at, does your CFO have that skill set in order to, have those relationships with analysts? Do they have experience working with analysts? Do they understand the metrics that the street wants? And making sure you have that person in place. Next really comes the controller. Again, that's who's that controller who can take you public, and maybe it's somebody that's already at the company, and maybe it's somebody you need to find externally. But really having that technical accounting and reporting background is really critical to that role. Experience with timely SEC reporting and knowing what it takes to close books and then turn that into kind of SEC reporting ready documents is really important. But once you get those two kind of leadership positions in place, I think it's a matter of really building out the rest of that team, including all the folks who need to do just the blocking and tackling of the accounting, the people who need to be in reporting, people doing things like stock admin, thinking about the timing of when you might want to hire somebody who would lead your internal audit function. So there, are kind of a wide breadth of roles to be filled. But I do think probably those priority two are those CFO and controller leadership positions. In terms of, are we continuing to see, the struggle to get these roles and the competition out in the market to get these roles filled? The answer is yes. It's been quite a while now that these are just very challenging roles to fill. So, and that continues, at least for the time being. And so thinking about that well in advance of the IPO, I think is critical.
And Priya, do you have any thoughts on team?
Yeah, one of the things I've been thinking about is the war on talent has been particularly intense, both for finance and legal. Those are two sets of skills that are very portable between different industries. I don't want to sound like a ghoul, but a cooling off of the economy may also help with the war on talent for employers. I guess we'll all find out together. I think a lot for pre-IPO and IPO companies about what's going on with their legal function. There are a lot of very, very good companies that end up going public without having an in-house general counsel. That is doable if you have, Lauren, like you, or your firm and your colleagues that are there, and the company is willing to keep you very integrated, not just for going public, but being public. At some point, though, it makes sense to have in-house counsel. A lot of companies who are private do. But a great example is what often happens with life science companies, where your lead lawyer in-house may be regulatory counsel. That's not the same. That may be a very, very smart person, but that person may not have any experience when it comes to public company reporting or the IPO process. So I think in an ideal world, you just make an actual decision, not a default sort of, we were just doing this, but make an actual decision. Do you want to have in-house securities counsel? And is that the most senior attorney at your company, or is it somebody who is reporting to a more senior attorney? It's not just the going public. public. My analogy is always to a wedding. It's not the wedding, which is a fun party. It's the actually being married. And similarly, it's not doing the IPO, it's being a public company. And it can be very helpful to have suitable in-house legal for that, not just for the IPO, but for the act of being a public company. Like those quarters, they just keep coming, right? They just keep coming.
Oh, yeah, there's a lot of work, especially in, like that first year of becoming public. It's really a lot of work for the whole team, especially legal. There's a lot going on there. And actually, one thing that does come up that companies ask about a lot is sort of that investor relations role, right? And whether that is outsourced or whether you hire somebody internally. And I've seen it definitely both ways, and it can work well both ways. There are some great firms out there that companies hire, and sometimes they might start with outsourcing that role and then kind of bring someone in-house. The one thing I have heard is that sometimes it's helpful to have, somebody with a lot of public company experience in that role, sort of helping out the legal function, to both like educate your employees and the other people in the company, as you start, you're shifting from being this private company to a public company with a lot of questions and a lot of new things to learn. So that question does come up quite a bit.
I think one of the things that's really hard about being a public company is the environment changes in a way that's exogenous to your business. So your business is your business, but we're in a season where the SEC has proposed rules about ESG disclosure, about cyber, of like so many things. And the reality is part of the cost of being a public company, beyond scaling and running your own business very well, is being able to respond to these regulatory pushes. And so seasoned IR, seasoned general counsels go a long way to helping for that.
Yeah, great. So moving on, and we've talked about sort of, internal key hires, as a company evaluates advisors to take them through the IPO process, what do you recommend is the most important factors a company should consider in choosing advisors? Allison, maybe I can turn to you. I know you've worked with, many teams, and wondering if there are specific elements or dynamics between various teams that you have seen to be most effective for a successful IPO.
Yeah, in the IPO process, I think, first of all, there are a number of different advisors and people involved. So, you've got your auditors, you've got the lawyers, there are the bankers, underwriters, a whole host of people that are involved in the process. And as companies go out and try to figure out who it is they want to work with, I think some of the things that are important is when you are evaluating different teams of people. I mean, first and foremost, does their communication style kind of jive with how your company works? Culturally, do they seem like a good fit? These are things that are all obviously very qualitative, but they are important because when you get into drafting sessions and, trying to get that first confidential filing out the door, and then, heading into everything that comes after that. I think that you want a team that's cohesive and feels comfortable talking to each other and is willing to give you very honest and transparent advice, and can really work closely with each other to problem solve. I think that that's important. And as you're meeting with people, that's not always the easiest thing to figure out. But, the more that you can, check references and get recommendations from people, or if you have people you've worked with before, lots of times that is important, just to know that culturally everybody's a good fit. I know that when we go out and we're, kind of pitching to work with different clients, one of the things that's important to me personally, because I've seen it be more successful, is just on my own team. I want a team that I've worked with before, just within my own audit team, right? So when I'm thinking about the manager who's going to join my team, and the SEC reviewing partner who's going to join my team, and, any specialists that are going to join my team, I think about building it out with people that, like, we all know we've worked together before. We know we can take a project to completion together. We know we can communicate well. And so as I think about building my team, that's something that I do. And I think that's important. I just think there's a lot of qualitative factors to consider. In today's environment, I will tell you that just cost-wise, rates have gone up, I think, across the board for most advisors. Those are your accounting advisors, your auditors, the lawyers, everybody's rates have just gone up in the current environment. And so, don't be shocked by that if you're talking to folks, and I would be wary of maybe immediately thinking, oh, I should go with that low-cost provider. Have those transparent conversations with people that you're meeting and understand why the rates are what they are, or, ask if there's something that can be done to accommodate, some special circumstances. But I would just say, don't let cost drive the ultimate decision, especially if you're feeling like you're close to that IPO timeline, because ultimately you want the team that's best for you to get you through this process, because it's a challenging one.
Yeah, it's definitely a long process. And I do think like a cultural fit is very important. I mean, you're spending a lot of time with all these advisors, late nights and just a lot of time in general. So it's important to communicate well and to be able to, be efficient, move things forward and work well together. Priya, what about you? What do you see from your perspective on this question, including when it comes to D&O insurance? And, I know price is a consideration there. It's very, very expensive.
For sure. Well, let me talk about two things. One, choosing advisors, and two, the cost, particularly of D&O insurance and choosing a D&O advisor. So broadly, I mean, Allison is so right about chemistry really mattering. And it's not just, late nights, but it's also anxiety-ridden issues that come up at the last minute. Like, are you going to be able to create goodwill with all of your advisors, some of whom are in a kind of go, no-go position for what you are going to do? So that chemistry and that feeling of trust is huge. I would also add to that just hardcore expertise and experience. And there are many, many good, Lauren, I'll use corporate securities attorneys. There are many good corporate securities attorneys on the planet. There are a fewer number that are very skilled at IPOs per se. Right, that is actually a particular animal. And I think it's important to be clear when you look for advisors, to be really clear about what is it that you're looking for. And it's not just a corporate securities attorney, it's a attorney and a firm, in this example, that's very good at IPOs. It might be, depending on what you're doing and the advisor you're talking to, some industry specialization. But I would look for and screen for and ask questions about market share and specific experience when it comes to your industry and for what we're talking about, more importantly, the actual act of doing an IPO. That is different than, in my world, renewing your private company insurance or even renewing your public company insurance. It is a different activity. Related, it can rhyme, but it's different. And you want to screen specifically for that expertise and experience. In the case of insurance, it's also consequential. One, because you're trying to put in something in place that's very personal to directors and officers. It protects them, right, from that personal liability, but it is enormously expensive. And the prices are actually starting to moderate as we are here in the summer of 2022, but nobody is still going to be happy about it, particularly people whose last IPO might have been in 2015 when it was much less expensive. And there's a reason why. And so just using data, in 2021, 4% of public companies were sued. If you look at the class of public companies, the IPO cohort of 2021, 7% of them have already been sued. Remember, it's a 3-year statute of limitations for that registration statement. So it's the IPO cohort of 2019 that's mature. 22% of those companies are currently facing a stock drop suit, a securities class action lawsuit. So one of the reasons the insurance is expensive is that it gets triggered a lot compared even to just mature public companies. But there is some good news that the price is moderating. If you looked at my pricing charts, it's kind of a horrible up and to the right, not the hockey stick we want. And it's moderating in that accelerations are decreasing and we're seeing some flattening. And the reason is that there was a game changer in the IPO litigation environment. And we can now do things in a corporate governance way that I think we might talk about in a minute, Lauren. That means that if you're sued on your IPO, you'll only get sued in federal court, not also in state court. So IPO companies are still being sued a lot, but if you're only being sued in federal court and not also state court, that's much better. So, getting right to pricing, the first quarter of 2021 was the height of the market. And at that point, on average, all things being equal, right? So I'm smoothing for offering size, company size, industry, like all things being equal, you were paying for the first $10 million of insurance, $2.4 million. That's a lot. If you look more at the last quarter, it's down to, on average, about $2 million. So still a very high number, but on a percentage basis, we are seeing some improvement. The other factor is what's the deductible. And as prices were getting very high, the market was highly capacity constrained. Again, if I look at the first quarter of 2021, our deductibles averaging closer to $15 million than say 10 million. Now we're seeing numbers closer to 10 million or under. So that's the first amount, like the deductible that you pay, about 60%. So that you can see that we're seeing improvement in the market. Still have to plan for this expense though, because it is very significant in terms of cost.
Yeah, that's interesting. Those numbers, certainly.
Interesting is not the word people usually use, but I appreciate your diplomacy.
Well, you mentioned corporate governance. So I think that's a good segue into our next topic. We touched upon this a bit in terms of board, composition and thinking about who's on your board, making sure you have the right people to, meet rules, and also kind of considering who may roll off, who wants to stay on. But another thing I want to talk about is sort of other features, governance features that late stage private companies may be thinking about, including, dual class or even multi-class stock structure, which we see fairly often, or at least being considered almost always, and other defensive measures that may be implemented in connection with an IPO. So Priya, what are the corporate governance issues that will matter in an IPO when it comes to D&O insurance?
You bet. And so when we think about corporate governance, I am focused, as somebody who thinks about risk for directors and officers, on what are the controls and procedures that can exist in the management environment that either make litigation less likely or tend to make it go away faster and for less money, right? That's the win. So just starting off, the thing I had just touched on earlier, you can put in your charter document something called a federal choice of forum provision. A federal choice of forum provision says to all of your shareholders who are buying in your IPO or afterwards, hey, you may have to sue us on our registration statement, but if you do, you're only suing us in our federal court. And big shout out to Wilson Sonsini, who was the lead law firm in Delaware for a case called Shabakuki. It is your partners, Lauren, who argued and won that case in the Delaware Supreme Court. And we all now get to take advantage of that. Of course, I'm very proud because Woodruff Sawyer arranged the funding for that game changer case in the litigation environment. In addition to federal forum provisions, there's also something called state choice of forum provisions, which means, again, you put in your charter documents, if you're going to sue us for a breach of fiduciary duty suit, and I'm assuming as you're a Delaware corporation, you can only sue us in Delaware, not Delaware and all of the other states where we may have shareholders. So again, a proactive move that you can take so that if you're sued, you don't have multi-jurisdictional litigation. Much better. Dual class is one of my favorites. If I were a founder, I would 100% want dual class as well. But the statistics are such that I'm not saying it's causation, maybe just correlation. Dual class companies are more likely to suffer from IPO related litigation. you will be priced accordingly. So, just to be aware. And then there's also normal corporate governance things that Lauren, you and your colleagues at Wilson will always advise on: Reg FD, insider trading. Some of these things, though, for those of us who are feeling like we're in a bit of a lull, those are things you can think about now, take a very proactive approach, be thoughtful about what you're going to implement, and also have a view to some of the proposed rules that are coming online. So think about, again, proposed rules for cyber and climate. D&O insurance underwriters in this season will want to know what's your answer to, are you ready if you have to actually comply with the new cyber rules, for example. And so taking a proactive approach to that will be important as well. So again, to actually handle your risk, but also as part of what we're saying to insurance carriers when it comes to putting together your insurance, corporate governance in a lot of ways, when it's well done, it is the fire sprinklers of D&O insurance.
Got it. That's interesting about these proposed rules. I do think that's really important for companies to start thinking about these. I know they're just proposed at this point, but it's important to start thinking about how companies will be prepared for those. And let's see, I think the next thing that I did want to discuss was sort of deal uncertainty and changes in deal timing. Again, I know we did touch on this earlier, but I wanted to get into a bit more detail here and sort of changes in deal timing. So we all know IPOs take months from the org meeting until pricing. Companies face a lot of uncertainty and change in the interim. And, it's not just sort of market conditions. There's a lot of different things that can happen, right? I mean, a change in management, could potentially delay things, or, maybe a quarter that wasn't didn't go as well as expected. All these things can sort of shift your timing and your window for an IPO. So, Allison, maybe you can speak to this. I'm sure you've seen many situations where timelines have changed or shifted. And I know these need to be sort of closely coordinated windows with, your financial statements, because they need to be for specific periods, right? So what are your suggestions for how a company can best navigate this uncertainty and work with the company's auditors to make sure they're prepared for any changes?
Yeah, I think, for those of you who have never been through an IPO or the kind of S1 drafting process and the related audits, there's always a certain degree of chaos. Even the most well-prepared companies, there's a certain degree of chaos. And so once, some of these timelines started to shift, and I had a couple clients of my own who were charging forward. If we look back to maybe January, they were charging forward to want, to get that initial confidential filing on file with the SEC by, say, May or June. Those timelines have now gotten delayed, but everybody was charging pretty hard, in that January through March timeframe when, we thought that it was a real possibility that those confidential filings could happen. And, through that, everybody's working so hard. There are things that inevitably come up during that process, and everybody's trying to kind of, play whack-a-mole, right? It's like, what's the issue that came up today? Let's go solve that issue. Now let's move on to the next issue. And so, once there is a pause in the process, I always encourage people to just truly take a pause, step away from that chaos that may have existed, and use that opportunity to kind of prioritize and refocus, because now you've got some time. In terms of the results, it might not be what everybody wanted, right? Everybody wanted to get this confidential filing on file. They wanted to move forward for that IPO, but this does give you that opportunity to pause and say, okay, what are all the things that I need to do? And an audit's going to be part of that. Maybe you need to get caught up on audits. Maybe you need to get caught up on quarterly reviews and figure out, like you said, which quarterly reviews, which time periods are going to have to go into that S1 depending on the timing. Make sure that you have a plan to get caught up. But then there are other things inevitably that have come out of that audit and S1 process that you now have on your radar that you're going to want to improve on. Maybe there's something you realized in your process isn't working the way you want it to work. Maybe you found errors in a certain area and you want to figure out how to prevent those areas going forward. So now's the time to step back and say, okay, how do I fix those processes? How do I make sure the right people are working on the right things? And how do I now kind of reprioritize and make a plan so that, over the next few months, I can really feel like I'm caught up, such that if the market opens back up and I'm now ready again, I can truly feel like I'm in a good spot to move forward, get that S1 on file, and take all the next steps in terms of readiness to then operate as a public company. So that refocus is important to kind of not keep charging hard the way you were, because I think you need to step back and say, well, how do I prioritize and move forward in the best way possible?
Yeah, that makes a lot of sense. I think stepping back and taking a look at what needs to be done and where your, potential next window, may be. I mean, even without the market, there are certain windows where, you don't see a lot of companies going out, right? Like the kind of August timeframe, between Thanksgiving and Christmas, those are always kind of windows that are harder to go out. And so I think there's always time to kind of step back and think about, where you need to be, what financials you need to be ready for the next window. Priya, do you have any thoughts on this? I know you talked a bit about, changing timelines before, but any other final thoughts on this piece?
I think nothing that I can add to what Allison has already said. It is the reality of the situation, and I will say one more time, I encourage you to make sure you have your adequate funding in place to get through some of the pauses.
Right. Well, before, we did want to leave a few minutes for questions, and before we turn to the Q&A, wanted to go into some key takeaways. So, I wanted to ask you both sort of, what's one piece of advice you would leave our community of entrepreneurs with coming out of today? Priya, I'll start with you.
So this is going to sound funny, but I actually mean it. When you're doing your planning, plan to sleep and hydrate. Like, it is a really hard process. And I know I've told this story before, but I've been in situations where I'm talking to the legal team, and in the middle of the conversation, I'm having this moment of like, are they drunk? Oh no, they're just sleep deprived. It sounds exactly the same, and you have the same level of judgment as well. So I think I may have said it in a little bit of a funny way, but as you are thinking about going public, this is not about pushing it through the narrow window you have so you can get the liquidity. You really want to think of what is a scalable and sustainable process. And that does mean thinking about who's who in the zoo, who's in your environment, who's in your ecosystem, and spending time and being thoughtful about choosing the right advisors. Allison said something earlier that's so important. If you're choosing your advisors based on who is the least expensive, it's going to be a painful process. You want to choose people who are experienced. There is a reason they're charging what they are, and you will be well served to surround yourself with people of that caliber. But seriously, also sleep and hydrate.
Thank you, Priya. Very, very good advice. Allison, what about you? Any key takeaways?
Yeah, I think, maybe one thing to just leave people with is, no matter where you are in this process, I mean, you could be a very early stage company and maybe you're thinking, I've probably got 2, 3, 4 years until I ever go public, versus those companies that might be really close to that process. No matter what bucket you're in, I think you have an opportunity to really at least understand, what are all the things I would need to do to get to that point in the future? Do I at least have that list of all the things I need to do? And that way you at least have sight of it. And, you might not need to do everything as quickly if you're that earlier stage company, but that actually gives you a lot more runway, which is a good place to be in. And starting to think about that, as you just continue to grow and think about, maybe we should start thinking about, getting a corporate controller now, or maybe now's the time to think about implementing a CRM. There are different things to think about along that process, and just having that full list and kind of revisiting it maybe a couple times a year or every quarter or however often it is, I think that's a good place to just start and at least have sight of that process.
Also great advice. Thank you so much, Allison. So now I think we'll transition to Q&A. I apologize. We probably won't have time to get to all the questions, but we will certainly do our best. And you can go ahead and submit any questions in the Q&A function. And I think Colin is going to help us out with this piece.
Amazing. Well, first off, Priya, Allison, Lauren, what a great discussion to start off our day. If you haven't submitted your questions yet, please put them into the Q&A box at the bottom of your screen. We'll try to get to them all. To start us off, couple questions from Jason. Thank you for submitting them. First one, appreciated your insights into the audit chair. Can you provide some commentary on the needed directors for the comp and governance committees? And I'll open this up to anyone, but Priya, you were nodding, so maybe I'll pass it to you and then add the other color to it.
So that audit committee chair position is always where I start because it is so critical. I'm sure Allison would nod vigorously on that as well. But of course, you're right. A public company does have to field some basic committees, all of which need independent directors. In terms of how do you what are they and what do you need? The three basic committees are audit, comp, and the nominating governance committee. It used to be that audit was the one that everybody was kind of scared of, if you will. But I will tell you, comp and nom-gov are having their turn in the barrel when it comes to regulators and others having serious expectations for independent board members. So part of the exercise here is maintaining people on your board that have industry expertise, but also adding the kind of directors that are used to helping companies on their maturity, easy for me to say, journey when it comes to corporate governance. And in the current environment, the good news is there are a lot of seasoned board members who do want to serve on boards. And so you'll access your network. I know KPMG keeps a list. I know Wilson keeps a list. Call me, lots of places. If you are on any kind of short timeline, or your spec is at all difficult, think about using a recruiter. There's a reason that is an entire profession. If recruiting were easy, those experts would not exist. And so that is something to think about, particularly if your timing is starting to get short on that. And even having a conversation with the recruiter can help you understand what makes a good spec. So that's a great thing to do. I'd also suggest kind of broadly that, I know Wilson and KPMG and certainly Woodruff, we all have guides and checklists for going public and the things to think about and make them available on our website. I'm very happy to send a copy to anybody. Take advantage of those resources as well. A lot of good tips for all of these topics in those resources.
One thing just to jump in from a legal standpoint on the board, obviously there's rules of the board needs to be a majority independent at the time of the IPO. There are phase-in rules that you can take advantage of, but Priya, just to make this point, based on how long it can take to get some of these directors on your board, that's certainly not something you want to be relying on, or certainly not planning to rely on. So just keep that in mind, as you take a look at your board and determine sort of who's going to be staying on, who is independent, and doing your analysis.
Super helpful. Allison, anything to add there, or do we cover the whole gamut?
I think they covered it very well.
Amazing. And 2 for 1. Jason's second question was, do you have a checklist of sorts that you could recommend? And we have links for that we're going to follow up with everybody on after this event. So Jason will cover that base after. Another question here is brand equity. Is the brand equity and investor ready or IR readiness crucial to the IPO process?
I'm not sure I understand the question, but I would say, yes, you need to have a coherent brand strategy that does need to be part of the process, right? I mean, going public is itself an amazing branding event for a company. Your IR strategy will obviously evolve over time, but I would defer to Lauren and Allison. I would think it's of critical importance.
Yeah, and I can chime in with a couple points of view here. In that S1 document that goes out as, the originally a first confidential filing, and then it gets made public once you're a little bit closer to actually, going effective. That document, while yes, the financials are very important, and that's where I spend all my time, the entire first section of that document is all about, the executives and founders' views of what is my business all about? What is it that I'm selling? What is it I'm bringing to market? And how am I adding value? And so a ton of time gets spent in the drafting sessions of the S1 focusing on, what is it that we want the public to take away as what our company's all about? Because at the end of the day, that's what people are buying into, and that's what's going to generate excitement for becoming an investor of the company. And so, there's an aspect of that is very investor relations focused and very much focused on the business itself. I will tell you that the other, common thing to think about is really what are the non-GAAP and operating metrics that we want to present as part of that document as well, and then becomes part of the future tracking and monitoring of the financial position. Even though they don't comply with GAAP, those metrics are very important to investors. So deciding what are those metrics that you even want to be putting out there, and what do the bankers think is important, and how do people get aligned on that? So I do think it's very important, and that does become a very large part of that IPO process beyond just the finance and accounting organization.
Colin, there were a bunch of questions in the chat and elsewhere about ESG, and I wonder if we should maybe hit those, Lauren.
That was going to be the next gear that I ship to. So as ESG becomes more critical, when's a good time to start building out your ESG story? And also, how does ESG translate through the IPO process?
Yeah, so, clearly this is a big area of focus right now. Sort of everyone's talking about it, figuring out what to do. There's certain new proposed rules. So, I think sort of the theme of this panel, right? It's sort of, I think, prepare early, start thinking about things early. We have these proposed rules out, start thinking about those, looking at them. How would you respond to them? Another big piece is disclosure, right? And how are you going to, present this in your S1, right? Is it going to be within the S1 or outside of it, depending on the rules? And so I think it's just important to start thinking about this early, what your strategy is and what your disclosure looks like and the different pieces of this. Where does it, are there reports that you're putting out separately, right? And then you want to refer to those, but there's a lot of different things that different companies are doing right now. So I think there's not one right answer, especially not at this point. But I think it's something to think about and certainly discuss with your advisors.
I mean, one thing that, and Lauren, I couldn't agree with you more, it can't be one size fits all. I think there's no question the bigger the IPO you are, the bigger the company, the stronger the expectations the market will be that you have pulled your ESG story together. And I do think ESG, it is a funny thing that we combine these three letters because I guess it's convenient and we can say it quickly. But in this panel, we've talked about governance a lot in some very specific ways that are extremely relevant across whether it's exchange rules or, because I want to do a better job on your D&O intrinsic, whatever the reason, might just be a law. The S around social, right? Like that's one of those places where things like the rules in California about do you have women or other underrepresented people on your board, those rules may be a bit in flux, but then there is the question, like, really, if the rules are in flux, are you definitely still going to go out with your entire board looking exactly like each other? That may not be a great strategy. We'll get questions and it will impact even the bankability of your program. So that S Again, depending on the kind of company you are you international, how mature are you as a private company, there's going to be increasing pressure on it. And then the E, and I do want to add cyber to it, the proposed rules are so serious that as we get closer to implementation of the rules, companies going public, whether or not you have a transition period, need to be able to respond to those. And that impacts everything from the board members you recruit to some of the controls that you have in place. I think, my summary is the SEC isn't making it easier to go public, right, with all of these proposed rules. I wonder if they know that. I think they know.
And when it comes to that climate proposal in particular, while it's not final yet, I think all of us are fairly certain that something will become final. It might not be in the form it's written in now, but, just to give some flavor for those of you that aren't familiar with that proposal, it does require a number of pieces of information to go directly into your financial statement. So what does that mean? It means that it needs to be audited. It means that at some point when you have to comply with Sarbanes-Oxley, that it will fall within the scope of your internal control over financial reporting. There's other information that doesn't go directly in the financial statements, but it would go in your annual report. So that means it would fall within the purview of your disclosure controls and procedures. And so all these things, really do end up relating to the financial reporting. And even for those companies going public, at least the way the rules are written now is it does require you to do certain of those disclosures, right at the outset of becoming public. So, it's definitely not something that you can punt for too long. Of course, we need to see what the final rules are going to be, but they're going to be, I think barreling down at us once they become final.
Amazing. We're almost at time, but I want to get at least one more question through. For the panel, how sophisticated should your FP&A function be in advance of starting up the IPO process?
I can jump in here and maybe give my point of view. I think the FP&A function is very important. Once you start getting into the mode of, you're going public, you now are going to need to help analysts set expectations about your business going forward. And as a public company, you're never going to want to be too far off of those analysts' expectations, right? The goal is always to meet the analyst expectations every quarter. And so communicating, for a CEO and CFO to be able to effectively communicate with that analyst population and say, here's what, we're tracking towards, here's how we're measuring our business, here's what our expectations are, in order to help them develop their expectations, you need a pretty, solid FP&A department to be able to produce information that tells you, here is what I think our revenue will be in, for the rest of the year, or even developing longer range plans. And so I think the FP&A department becomes very critical in just that forecasting process, because that's what then drives what you're going to go out in earnings releases and say what your expectations are, and that's going to drive the market.
Amazing. Thank you for that. One last one for Priya, because you were talking about board directors, how to determine independency.
Independence. So Lauren is actually probably better to answer this question. Lauren, do you want to hit it?
Sure, happy to. In independence, we're really talking about independence from management. SEC has independence rules, and both of the exchanges, NYSE and Nasdaq, have slightly different definitions of independence as well. So there are certain, per se disqualifications, right? And so it's really an analysis of each, individual director, whether it hits any one of those, per se disqualifications, and, whether there are any other factors that the board should take into consideration when determining independence. And it is, a determination that the board needs to make, and obviously with help from your advisors. And in terms of whether there are any concerns, any other factors we should be taking into considerations. But, so SEC rules, NASDAQ rules, NYSE rules, and kind of looking at those in conjunction kind of with the full picture to determine whether they're independent from management.
I think the only thing I'd add is in that exercise that Lauren or her colleagues would take you through, the thing that can surprise people are the social relationships, right? So financial conflicts kind of feel obvious and you need to disclose those, and that's actually not very hard. But if it turns out everybody on the board belongs to the same golf club and we all went in together on buying, it's a famous example, buying a condo on the island that's owned by our CEO, you're going to have a problem. That's not going to be considered independent in some circumstances, most circumstances. And so that those tricky social relationships, it's really tough because if nobody knows anybody at all from any place at any time, it's kind of awkward to work together. But if if you all went to the same school, that may end up being a problem. So that's not obvious. And that is something that has to be examined as well.
Amazing. Well, we're at time. And Lauren, Allison, Priya, thank you so much for sharing your incredible insights on preparing for and staying on track for the IPO. Hopefully everybody online enjoyed those. And I appreciate all of you taking the time today. So thank you so much. If you're interested in booking a meeting with our partners, please use that link in the chat box. We will follow up with them after the event. Before we transition to our next session for the day, executing your IPO, please take this time to refill your coffee cups and take a short break. We will return shortly. Lauren, Allison, Priya, thank you so much.
Thank you.
righty, welcome back everyone. Next up, we have our panel of experts to share on how to execute your IPO. Friendly reminder, we're going to open up for live Q&A at the end of this panel, so please submit those questions for us in the bottom of the screen in the Q&A function throughout the discussion. As you settle in, we want to get a better idea of who we have joining us. So I'm going to launch a quick poll to let us know in the next 12 to 18 months. Are you planning on starting the IPO process? First one, headed in that direction. Second, yes, but not within that time frame. And then the last is not quite yet. So let us know where you are. This will help our panelists understand where they need to target their discussion. Appreciate you participating. We're going to let this go for another minute, but I don't want to waste too much time. So thank you all for participating. I'm going to end this poll, share those results. Looks like a lot of you are headed in that direction. Some not in that time frame, and others are just waiting, not quite yet, but here to learn. So awesome, perfect makeup of people. So without any further delay, please join me in giving a warm welcome to our special guests. Our moderator is Jack. He's the head of US listings at Nasdaq. We have Lauren, who's the CFO at NerdWallet, and we have JD, who's the CFO at Matterport. Jack, JD, Lauren, welcome. Jack, over to you.
Thanks so much, Colin. And hey, JD and Lauren, good to see you again. So for the audience, thanks again for tuning in to this particular seminar. It's great to have you all here. And as Colin mentioned, we'll have some time at the end for Q&A, so you can put that into the chat there. And as you probably saw with the first panel, we'll filter through as much as we can. Obviously, we want to hopefully answer everybody's question, but we'll try and prioritize those as well. And so just briefly on my background, Jack Castle, I'm the head of US new listings here at Nasdaq. So for me, I have the best job in the world that I run our IPO business and get to work with these incredible companies and specifically their teams and executives as they are going through this exciting process of transitioning from private to public. And again, with our particular team, we all love our job because we're working with these great companies at such an incredible milestone and achievement of their just life cycle, corporate life cycle. But there's a lot of planning that goes into this, right? There's a lot of just strategy, planning, juggling, all of these activities of getting prepped and ready to go public while also having to manage your day job. So you're going to hear from two of the best that recently did this with us on Nasdaq last year for an IPO as well as a SPAC transaction from JD and Lauren. So without further ado, I'll actually hand it over to you both to give a little background on yourselves and maybe even on how you ended up landing at NerdWallet and Matterport. So Lauren, I'll start with you.
Perfect. Thank you. Great to be here today. So I'm Lauren St. Clair, the CFO at NerdWallet. And a little bit about my career and how I ended up here. First off, I started my career on the product side and spent my first few years at a very small software startup. And at some point I realized I wanted to see how things were done at scale. And so I ended up moving to a very large public company and spent the next 13 and a half years at eBay, where I transitioned to finance, had a ton of great opportunities across all of the many business units and in a variety of different finance roles. And about 24 months ago, I decided to start looking for my next opportunity, which brings me to NerdWallet. And some of the things I was really looking for, one, I wanted to take the #1 finance role at a company. I also really wanted to take a company that was ready for a transition or ready for a big liquidity event. I wanted to experience that and take my learnings at a public company to a smaller company looking for that type of experience. And I really wanted to be with a team and a leader that I resonated with and with a product that I could identify with and had a great mission. So that's how I chose NerdWallet.
All right, well done. Thank you for that. And JD, tell us a little bit about your journey.
I've been helping technology startups and companies in their growth phases for about 20 years now, working on strategy, fundraising, scaling, including IPOs with both US and global companies. And I had the opportunity to help companies through all types of capital transactions, including equity and debt offerings, and 6 IPOs. So it's been a fantastic experience. Initially, I helped companies as a corporate and transactional lawyer, and then later moved into the CFO role about 15 years ago, and enjoy that very much. And I enjoy actually bridging both of those roles when I can. I started working in the property technology space about 10 years ago, and found that I really enjoy the combination of real estate design, architecture, along with technology. So now it's a personal passion to find opportunities that combine that. And I found that with Matterport. And so I've been with Matterport for 5 years now, or almost 5 years. And about a year ago, as you mentioned, we completed a very successful de-SPAC transaction, which I think we'll talk about today. I got to Matterport because I have found, I think, the mutual or the multiple passions coming together in property technology, and was just looking for another opportunity to work in that space and grow a business through its growth phase and scale it up and take it public again on the Nasdaq. So that's how I got there, and really enjoy it thus far, and I think I will for many years to come.
Yeah, love that. Well, I mean, just a quick feedback. Both of you have that passion that comes through right away. So bravo on that. And that's helpful background to just kind of start on not only how you landed there, but then started with that conversation and kind of, as I had teed up earlier, the preparedness, right? And kind of, so we saw last year over 1,000 IPOs as well as SPAC combinations in 2021. So high watermark for the US capital markets. It was just, again, unprecedented volume. And so we saw a lot of companies that seem to accelerate their process, whether it be the IPO or kind of the SPAC transactions. So Lauren, I'm going to start with you here, but when did you start to, as we think of that timeline, when did you start to really initiate that preparation and even start to engage the service providers and kind of that speed? What was the initial tempo?
Yeah, so just quick background. I was actually at NerdWallet for maybe only 9 months when we IPO'd in November. So the reality is this process started long before I even got there. And it probably sounds obvious, but I do think preparedness starts well in advance of even considering an IPO. And I think, especially during these very volatile and uncertain times, like just being able to manage your business through ups and downs is just one of those huge things that I think management needs to recognize and consider as they start thinking about the next phase of their journey. For me, when I came in, I first assessed, do we have a robust close and forecasting process? And do we have the right tools and systems in place? And I walked into a great situation where, from a finance perspective, I had a really strong team. We had those processes, those systems down. We had just implemented a new ERP system. So for me, I walked into a great situation. I was there for about 2 months when we decided to put the pedal to the metal and start the process and get it done as quickly as we could. So some of the other considerations, the added disclosures and the cost of reporting and the regulatory requirements, worked a lot with my legal counterpart. We all know there's a lot of functions that need to support this effort. We also worked with our auditors to make sure that we could start speeding up the close process, ensuring accurate and timely reporting. We had done a step-up audit the year before, which I think was incredibly helpful for the controllership team to start getting a sense of the increased rigor, the questions we would be asked, as well as just those shortened timelines as well. And then we also really started to button down the forecasting process, and we really started practicing earnings calls ahead of time and just simulating what that would be like and the timing itself. I think those are probably some of the big things. Maybe given JD has been through this a ton, would love to hear his perspective on maybe lessons learned and what he did or didn't do this time around.
Yeah, JD.
Yeah, thanks, Lauren. Well, I would agree certainly with your first point to start early. I told my team in I think it was August of 2020, I said, let's get on a path to becoming public company ready in 18 months. And I said, we're going to do this methodically, and we're going to do some of the things Lauren just talked about over that time period. And I said, it will be an exciting time and a bit of work, but we've got time to prepare. And then in October, we decided to go public immediately. So it was quite a big change in terms of the pace that we had to implement all of the public company readiness. So we tried to start early, but it didn't quite work out the way I had intended. And so, of course, earlier than you think might be a great time to start because you never know, given the market readiness, when it's time to run the hurry up offense and get it done. But one of the things that we did, I thought that was very helpful early on, is we conducted a needs analysis for the company with our auditors IPO readiness team. And I thought that was incredibly helpful to get a third-party perspective, but one tied very closely with our auditor about our readiness. And it just ultimately gave us a great roadmap of what to do. And so I thought that was money and time well spent early in the process. And it actually provided a lot of support for us to the board and the CEO about what was needed even before the transaction became a high probability to invest to ensure that we could become a successful public company. So we built that project plan off the needs analysis, and we just made steady progress, but then actually had to accelerate it by a whole year just to get it done. And the place from which we started was a bit different than it sounds like, Lauren, your case, where we actually hadn't had any audits in the past. And so you can imagine what our close process and systems were like. We were running a very thinly capitalized G&A function by design. And thus we created this long roadmap, but we in fact had to fleet up incredibly quickly to get to our announced combination date, which was in February. So just a few short months later.
Yeah, that's really interesting. And JD, just follow-up question on that, and Lauren, similar. When, as we talk through kind of now's the time we're going, and both of you seem to, there was a meeting, there was a decision, and now we're go. But what was it that kind of led up to that from a board level, from an executive team that said, hey, this is the time. We're at a maturity level, the market's there, right? There's a lot of variables that go into that decision. But for Matterport specifically, starting with you, what was it that kind of led into that decision that said, hey, we are ready, let's go and execute?
Yeah, from a business point of view, we were seeing continued strength in the customer segment, the revenue growth, and all of the operating KPIs. And one of the things I like to tell the executive team as well as the finance team is, you're starting to get into a place when you can go public when you're breaking records every month. You should be breaking records up and down the income statement every month, every quarter, because the business then's really humming operationally. And we started to see that in that 2019, 2020 time period. So sustained record breaking of our operating KPIs was a nice signal. And then the second point, I think, was we were at a point which we could choose, which path to go down for our next round of fundraising. We were actually operating cash flow break even, so we didn't need to raise capital. We had choices in front of us. It was a nice position to be in, and particularly in a volatile market. And so we explored different options, from private capital to using capital off our balance sheet to the public company option, all manner of IPOs. And we essentially surveyed the market, did a little bit of informal testing of the different options. And for a variety of reasons, the SPAC transaction IPO was the most attractive for us. And then sort of combining those two major factors together, business outperformance on a sustained basis and the transaction elements around an IPO, kind of made that decision clear for us, or made the decision easy. And that caused us to press the go button and then do all the work to actually execute.
That's great. And Lauren?
Yeah, so I always tell people when they ask me that question, like, when do you know? I go back to the why. And it's always a balancing act. And we really wanted to consider customers, we wanted to consider shareholders and employees. And certainly our investors at the time when making this decision. I think very similar to maybe how JD thought about it for Matterport, it was really about how we were evaluating some of our financing options that would help us advance our mission, and that made sense for our business and those constituents that I mentioned. And for us, we felt like the best thing to do would really to go through the IPO process. We thought it would allow access to more types of financing and really more quickly than we could do as a private company. And so for us, it was really about the why. And like I said, when I came in, we had a lot of those processes and systems already in place. So the why with the, hey, we think we're also ready for that, is why it made sense for us at the time.
Yeah, well, that totally makes sense. And I love starting with the why. And again, an interesting piece of this and why we invited you both to share your experiences is because you did go different paths to the markets, right? And I think that's very interesting, especially in the dynamic markets we're in right now. We saw the number of SPACs. We've covered that quite a bit here at the Entrepreneurial Center from a topic perspective. And there's a lot of noise out there, right? And especially there was when you both entered the public markets. And so maybe JD, I'll start with you on that because you did choose the SPAC path versus the traditional IPO. So maybe just walk us through at least the mindset as you started to research those different options and why that path made the most sense for Matterport.
Yeah, sure. You know, when I first heard about the de-SPAC option was actually 25-ish years ago. I think it was more commonly called the reverse merger. And so when I heard about it again a couple of years back, I thought, oh, you know, no, I don't really want to do that. And so that's the position from which I started. So I had to kind of set aside my history of knowledge and look at it again. And the transaction type and the elements have certainly changed quite a bit since kind of generation one of SPACs. So for us, it was about looking at all the different transaction types, as we talked about, from private to public. SPAC was just one of them. And what happened when we informally surveyed the market in the SPAC side of the transaction types is we found a wonderful partner. And I think that's the first and perhaps most important part of the de-SPAC transaction is, do you have a partner that you can work well with? It's like any other lead investor in a financing round. There's much more to that relationship than just the capital. And in our case, we actually knew the Gores Group from prior work. And so we knew their experience in property technology companies, including partners and customers of ours. And that particular group has a very long track record of successful SPAC and other combination transactions. And so the partnership element was a big part for us. And that gave us a lot of comfort that this was a transaction type to look into further. And then from there, some other interesting, attributes fell out, that the amount of the committed capital and how that played into funding our business plan, the valuation potential there relative to other transaction types, not just the number, but also the certainty of retaining that valuation through the transaction execution process. And that's something that I was looking to risk mitigate from prior experiences. And then finally, the de-SPAC transaction is really, of course, a merger in a lot of ways. And so the certainty of closing was something that I was looking into, and particularly in a volatile market. And that transaction structure provides a high certainty of closing, and there's different ways to help adjust and increase that as well in the negotiation. And I felt that particularly as the markets got noisier, and now they are quite a bit noisy, that would be very, very valuable to us down the road. Ultimately, it took us about 9 months to complete the transaction. And so having valuation fixed, committed capital, and certainty of closing was also quite important and valuable to us as time elapsed, because we know that in some ways time can kill all deals, and so we need to I wanted to mitigate some of those risk factors. And so for us, the de-SPAC transaction turned out to be a good one.
Oh, that's great. And those are obviously attributes everybody's looking for in a deal, right? Timing, execution, money's there. And shout out to the Gores Group. I think you nailed it too, as you look at the partners. But those, as you joked, even 20 years ago, the Gores Group was one of those perennial SPAC issuers, right? They had done this, they had the playbook, they have the group of investors, and they're obviously good friends to Nasdaq as well. So it was great to see that partnership come to fruition. And so Lauren, then similar question, obviously you, as you shared kind of the why behind the IPO, but did you have an opportunity to look at the other options? I guess there's even a direct listing in there. We haven't seen as many over the last kind of 12 months or so, but thinking of those different options, how did IPO come to the top of that list for you?
Yeah, exactly. We actually considered all three, direct listing, SPAC, and the sort of traditional IPO route. When we first talked about direct listing, I mean, one of the reasons why we also wanted to be public was to give more liquidity to employees, and that would certainly allow that. But we also wanted to raise at the time, and while the rules have changed a bit, it was still very new to do the direct listing and a raise. So we decided at that point it probably wasn't the best thing for us. And then we started exploring sort of pros and cons of IPO versus SPAC. I think JD had a really great experience, and I think he had that relationship there, which was great. I think that was one of the concerns we had was, who are the sponsors? What's that relationship? What are some of the other sort of elements as part of that deal? And just thinking about sort of cost and dilution and things like that. You know, we just felt that our maturity, our financials, and the story that we had and the narrative was primed for an IPO. And so we ultimately went down that path.
Yeah, well, and successfully. So, and Lauren, maybe sticking with you, I know, obviously, as you shared, you joined about 9 months prior to the IPO, but you know, we have seen this trend of companies and CEOs and CFOs specifically meeting with both investors, kind of the buy side, as well as the analysts, especially research, sometimes months, even a year or so ahead of an IPO. I'd love to just understand how you started to weave that into your process and see if you have any recommendations around that, if there's a right number of meetings or cadence, or how much that really factored into kind of the later stage of the process.
Yeah, it's such a great question. And quite frankly, for me, that was probably the biggest lesson to learn. So I hadn't been at the company very long. In the sort of few months that I had before we made the official decision, I was meeting with investors, and I did have the opportunity to meet with a couple of the sell side analysts to get their thoughts and just hear how they speak about sort of what would be a comparable peer set, where would they sort of put us. In terms of like what grouping. For us, it was like fintech, general internet, marketplace. How do we talk about the business? So that was incredibly helpful. But really what I learned is continuing to meet with investors who are in your cap table already or potential future investors, I think is so important. And so if I had a longer period of time, or if I did this again, I would definitely make sure that the engagement with the investors that we would have liked to participate in the IPO was earlier, was much more often. So you build those relationships. People know your story ahead of time. They know management ahead of time. I think that would have been incredibly helpful. We made up for it a little bit and did more test the waters and had a pretty big list for Roadshow, but that's definitely something I would recommend early and often, getting in front of, again, current investors, but also potential investors.
Yeah, great point. And I'm writing down notes as well, so I appreciate that. And JD, now you've had, again, experiences through both the IPO path as well as the SPAC transaction. So I would love to get your perspective, not only on the IPO path, but maybe even how that's evolved. Because we've seen this trend kind of accelerate a bit over the last, call it 2 years, 24 months. But then also through that SPAC transaction, how did you really kind of game plan that sell side?
Yeah, on the sell side, I agree with Lauren's comments about meeting with investors early and often. And even if you don't have a fundraising going on or one that meets their needs because of the benefits that you described, we did the same thing. I try, anytime I build a capital syndicate, if it's private or going public or public, I try to create diversity in stage of investing or investor, the capital amount they like to invest, their specialty, and their opinions. I just believe it helps with all kinds of future and unforeseen needs to have diversity in all of those elements. And therefore, I believe it delivers alpha. And so even when we were private, I'm building that diversity in the syndicate. So as I'm moving to public, there are some investors that already know me or know us, and that's a really easy conversation. And as you start ramping up to going public, to Lauren's point, you started meeting with those investors as well. So when the time comes to pull the trigger, be it a traditional roadshow or a SPAC transaction, it could be a PIPE roadshow. Those investors have already seen us, and we were developing that continuing relationship. And in fact, in our transaction last year, all of our PIPE was oversubscribed by relationships that we Matterport brought to that roadshow, and then we supplemented it, and we were able to address mix and allocation with relationships from the banks, and so that's how powerful that was. We were in the driver's seat in the PIPE transaction, which is akin to the roadshow and the traditional IPO, because the relationships actually came from us, Matterport. So I think that's a huge help. And then similarly with analysts, learning how they position, how they look at comps, what are the KPIs that they look at, what are the risk factors, all the things that Lauren talked about. I completely agree with that as well, because there's a little bit of adjusting one's positioning and how we talk about the company to what can fit in the market, frameworks and the time available they have to work on any particular company, as well as balancing that with how we want to describe that we're different too. So all of those early conversations really helped in either transaction type, going public.
Yeah. And you mentioned an interesting point, and a lot around kind of setting up some of these investor meetings, right? And most deals you're going to utilize both an investment bank and sometimes different advisors. So maybe JD, staying with you here through your experience, maybe just give us some perspective on how to quarterback, not necessarily the selection, but how you work with those different groups that are advising you. But again, at some point, there's a lot of cooks in the kitchen, right? And you have to do what's best. You have to make certain decisions based on, all your constituents and kind of their influence. So maybe just a little perspective on how you work with the different groups throughout the process as well.
Yeah, there were a lot of cooks in the kitchen this time in particular, because we were going so quickly and we didn't have the team internally yet to do this ourselves. And so we engaged the IPO transaction services team of our auditor, of course, our audit team. We had a separate accounting firm that did IPO execution, help with the actual work itself, drafting and some of the more complex accounting around SPACs. And then, of course, we have the sponsor banks as well as our own bank working on largely the PIPE transaction and marketing and those kinds of things. So it added up to a lot of people, and then lawyers, everywhere, as is typical. So it worked out great because everyone was so passionate and motivated to execute this transaction. The base alignment was there. We also appointed a project manager. There was a recommendation from our audit IPO services team and their needs analysis that we appoint a project manager and have that person be internal to Matterport, so they knew everything about Matterport, and we did that. That was a new step that I did this time, and enjoyed that very much. It was that person's first time running an IPO, so we had some fun kind of fleeting up there and supported each other. But that actually gave essentially a leader across all the different stakeholders and supporting firms that we all answer to. And we demonstrated that by example. I answered to that project manager when I had tasks to do too. And that really helped keep everyone coordinated and ensuring that we got things done on time. But it was quite a big group, and it could have been very chaotic at times because of that. And adding to that, of course, this was all during COVID, so the whole thing was remote, and so it made it even more complex in some ways. So those are some of the things that we did, and then certainly a lot of these firms finally had so much repeat experience that we could lean on their expertise and their efficiencies to help us where we didn't have particular knowledge, let's say, about warrant accounting and de-SPAC transactions or some particular issue, and that helped a lot too.
Absolutely. And Lauren, same question. Love your perspective on it as well.
Yeah, very similar to what JD said, and he's gone through this many times. So I'm actually glad to hear that. I think maybe I followed some of his recommendations unknowingly. But two things that we did right away, given that I hadn't been through an IPO before, and most of the management team and a lot of folks on the internal working team hadn't gone through this experience, we did hire an external advisor. Who's someone who could be on management side, who could help share her experiences with us, who had no vested interest or anything else but making us successful. And so she was just a great resource for me and for the team to bounce ideas off of, and just help also guide us through, hey, this is the next step. This is what's going to come up. Start thinking about this now, or you have to make a decision by this date. So for me, that was incredibly helpful. And then similar to JD, we actually decided to hire a project manager in-house as well. It was a person that I hired onto my finance leadership team. He came with a very diverse skill set. He was a CPA, but had transitioned into corp finance and corp dev, and so had a lot of great experiences. And he was able to quarterback the whole project for us and help to manage the internal teams as well as the external teams that was part of this. We had a very small, as you can imagine, it's a small but mighty team internally that tends to do a bulk of the work. One, because there's confidentiality, and two, we just wanted to keep the touch points really succinct. So he held us all accountable. And then the three big groups, there's obviously a ton more, but the three big groups that were in the weekly working sessions, our external counsel, as well as underwriter counsel, our syndicate and our banks, and then obviously auditors play a big role in this and making sure that you can get everything done on time.
Yeah. Well, that's great to hear, because obviously it led to not only successful outcome, but obviously also allowing you both to manage your day job in addition to the process. JD, I want to just hit on one piece that you had mentioned around the virtual nature of a lot of these meetings. And this has been a transition we and our broader ecosystem has gone through over the last 18 to 24 months now. Which is crazy to say 24 months that we're 2 years out of this or into this, I guess. But as it came to the investor meetings and the roadshow, what was the split for you for in-person and virtual? And can you share some of the insights and then how that led into the roadshow and some perspective on how your investor meetings went?
Yeah. Our process was in the heart of the lockdowns here in the United States and in other countries. And so we did our entire investor roadshow, pipe marketing, and investor or analyst work remotely. We did it all on Zoom. And I actually found it to be incredibly efficient. The alternative is to fly around and get in cars and go up and down buildings. And it can be much more exhausting, at least that has been my experience, and there's a lot of time in transition. I will say it's super fun to do the live roadshow and travel the planet, and so I enjoy the experience, and neither is ineffective. They both work, but the Zoom approach was just so efficient that I recommend it. In fact, now that we're public and we're seeing banks move their tech conferences back to in-person, we're trying to actually supplement with virtual investor meetings as well. We're trying to keep some of that Zoom efficiency or the virtual meeting efficiency in our investor relations program. We did ultimately add in some kind of small group, more dinner-oriented meetings that we feel adds a lot more to the relationship than the 25-minute, 30-minute sprints throughout the day that you do in a heavy meeting day. So that's kind of how we try to mix it together between virtual and in-person now, really focusing more on relationship when it's in person, and the hard data, you could say, when it's a Zoom call or a quick call. But our process, I felt, went incredibly well. From a total virtual orientation, and that was a first. But I'd recommend that as part of the process for anybody else going forward.
Yeah. Okay. And Lauren, how was your experience with that? Maybe what was the split, and even looking forward, I'd love your perspective on those engagements.
Yeah, very, very similar. We were 100% virtual for all of our Test the Water meetings and for our official roadshow. We were on the road, call it mid to late October of last year. And so while things started opening up, people actually just found it more efficient. To JD's point about scheduling meetings, you can also give investors more flexibility on timing. So for instance, you don't have to meet all your Boston investors on one day and your New York investors the next two, or maybe the Midwest. So you can really mix it up. And so it provides more flexibility, I think, for all parties involved. I think for me, I do miss the in-person meetings. I think there's just an element of relationship building that is a little bit harder on Zoom, maybe a lot harder on Zoom. I do think sometimes it's also harder to read the room on Zoom. Some investors sometimes turn their cameras off and they're there on audio. And so when you're sitting across the table and you can look into, read the reactions and read the room a lot better. So I do miss that. Since then, we've continued to do a bulk of our meetings, I would say virtually. When we do NDRs or bus tours, we do them remotely now. And then we've also did start going back to conferences. And it is nice to meet people face to face. Like I said, I think the relationship building is much stronger in person, or just it's a little bit faster that way. But I do think moving forward, we'll look to do a combination of those two things.
Yeah, well, we loved having you both in person for the bell ringing ceremonies. So thank you for at least making that happen.
Yeah, we wouldn't miss that. That was a lot of fun.
Yeah, that's we'll have to have you back here. We got some anniversaries coming up here soon, so I have to speak with Lisa and Kate. So then maybe transitioning as we get through IPO day, we have, and as well as kind of the successful transaction and reverse merger, and now we're trading, we're out as a public company. One of the most important quarters for any company through this kind of transition is that first quarter, right? And really being able to hit your numbers, for lack of a better analogy. But I guess when, Lauren, started with you, when did you know that finance was ready to really operate as a public company? I know you mentioned kind of all the practice leading up to it, but was there an aha moment? And as you looked out at the subsequent quarters, when were you like, hey, we've got this, and this is from your perspective, we're ready to go?
For me, it was really around predictability and knowing what levers we had to help manage the business. And very much to your first point, you want to come out of the gate and you want to do that beat and raise, and knowing and having that confidence on how to forecast the business, for me, was one of the largest factors. At the same time, in order to do that, you need to be able to close the books, and you also need to be able to report timely. And so probably the big aha for me is when we were able to shorten our close cycle from, call it 10 to 12 days down to BD 5. And for us, that for me showed that we had the maturity and we had the process and the systems in place to do that.
Yeah, and JD, similar question. Obviously, there's a different set of transaction in regards to the numbers you provide, right, earlier in the process versus historical through the S1. But when was it for you and your respective team that you knew that, hey, I can sign off on this, we're ready?
Yeah, similar to Lauren's experience, we worked on we practiced, and what my old high school soccer coach said to me all the time, or to our team, was, what you do in practice is what you do in the game. And so I brought that concept here, and we ran a full public company process all the way through to the earnings call with Q&A by the investment bankers rather than the analysts. And we did that before we went public, every single step. And the only thing we didn't do was file the 10Q, but we'd effectively drafted it when drafting the other S1, S4 documents. So we'd actually done the entire process. And so from an operational perspective, I felt like while I wanted to do it twice, at least I'd done it once, and we could then be public. From a financial results perspective and business performance perspective, we had actually built a beat and raise model. It's a little bit different than our forecasting model and our budgets, but a beat and raise model based off some empirical data our bankers helped us gather by successful companies who had done this in the past. And that helped us create our guidance and give us a margin of safety between what we thought we could do in the guidance. And once we had that running and we ran that a couple of quarters, we felt like we had a model that worked. And then kind of combining all that together told us, yes, we can support this business as a public company. And so, I'd encourage, everybody to do those steps. So helpful, and it lowers one's stress level when you get to that first quarter after closing the IPO, for sure, to your point.
Yeah, that's really helpful. And so one more question, and I do want to have a key takeaway, and then we'll get to Q&A here. But, we've seen really a growing effort for companies in the ESG space. And we're seeing this both for late stage private as well as public companies. And some have actionable strategies and some are working on it. As you started to engage with both the buy side and sell side, you looked at your own strategy and operations. What is your, and JD, I'll start with you. What's been your approach to ESG and how that weaves into Matterport's narrative?
Yeah. So from a pure kind of public company perspective, we developed an ESG program by actually working with the Nasdaq's ESG advisory group, kind of similar to the IPO process in a way. We worked with that group to develop a set of benchmarks that other companies are doing that are somewhat similar to us. And that helped us create a plan and a roadmap for our ESG efforts. And that's what we're executing to now. And that also is based on kind of budget allowance and what we can do on an in-kind basis, because Matterport's technology is actually really helpful for other companies' ESG efforts. We create digital twins of real world spaces, and that can be very useful to, on the environmental side, on the social side, access side of an ESG program. So for us, we started with, kind of benchmarking what others do, and that helped inform our program. We brought in 2 people who have tremendous experience in this space, including from Walmart.org, and at scale, therefore, to help us lead that program. And then at the same time, Matterport's kind of technology is very relevant to ESG, so we can layer in some of our own activities, our own business, our own use cases for the technology to even augment the program further. So it's in the early days, and it's a multi-year effort for us, but feel really good about some of the contributions we've made thus far. And for example, public safety, education, diversity and access, and inclusion, and that'll just keep rolling forward because now we've got that kind of well-defined roadmap of leading practices.
Yeah. And Lauren, how about NerdWallet's approach and kind of just broader thought or thesis on ESG?
Yeah, we are still very early days, quite frankly, but we did start with our assessment and we partnered with NASDAQ to kick that off and first see what would be the areas of focus. What's great about, I think, NerdWallet right now is that we want to help people and democratize access to financial education. And there's a lot of ways that we have been already putting into practice some of the ESG pillars that we've been talking about today. And, we have a very big commitment to CSR and diversity. And so what's nice is that these programs were actually sort of already homegrown internally first. But definitely, like JD says, do the assessment. Be really clear internally on what is important, where you're going to focus your time and effort, start to build out, I think, the metrics and the methodologies and sort of the process that you're going to use to follow through on what you say you're going to do, and start doing that now. And that's where, I get super excited. It was already underway. We've sort of formalized it, and starting to think about a program more holistically, and now starting to track and measure that progress so that we too can start to report externally and more publicly about the progress and the areas of commitment that we're making.
Yeah, well said. Well said. Well, and I think also it's just as you nailed for both of you, but Lauren specifically on, there are some companies that aren't there yet, and being authentic with that is, that's your reputation, that's your brand in market to these investors. And so we've seen, unfortunately, certain companies that try to move the needle a bit more. They try to run before they tie the shoelaces, so to speak, and they get tripped up. And so I think you nailed that. It's better to have a concrete story that you're telling and growing into than trying to get too far ahead and points for something that you haven't yet earned. So Lauren, I'm going to come back to you. We've got a few minutes left, so we're going to start with, before getting to Q&A, just maybe a key takeaway for our audience here, a group of entrepreneurs and finance professionals, maybe something from your experience going through this process.
Yep, I have maybe 3 quick ones. I would say, I think you've heard JD and I say this a ton of times, but practice, practice, practice. It's going to build that muscle. I think it also builds confidence, and I think that's incredibly important. The second thing, stick to your plan, follow the course, stay the course, focus around the long term. Listen, we have to be aware of the external environment, but we certainly can't control it, and it's really hard to time it, so don't even try. If you stick to the long-term plan, I think that's the best thing. And then the third thing for me, do not underestimate the impact on employees and how much education and communication that it does require leading up to the IPO. And then certainly afterwards, there's a lot of nuances and a lot of new things that happen, and just making sure that employees understand it and feel comfortable and know how to operate in this new world of a public company, I think is really, really important, and something I didn't fully appreciate until afterwards.
Yeah, well said. Well said. And JD, similar question. What would you share with the audience?
I agree with all of Lauren's points. Those are great ones, some of which I had on my list too. So different ones I'll add for fun and to hopefully share a bit more. One is, I find a lot of value in keeping the board and the CEO updated on what it really takes to be prepared and to get public and then be public. Not everyone knows the gory details or wants to know perhaps, but it's significant, as we've talked about today. The team, the process, the fleet up, the cost, the impact of changes of being as a result of becoming public. So keeping them updated all along the way, I think has a lot of value. Later when things get challenging and tough and we have to sprint. And then lastly, I try to insert a little bit of fun into the process, a little bit of celebrating the small wins and the progress. And I try to bring a lot more people on the working team into that fun element. Not everybody's directly involved in the transaction, but everyone is really important in actually getting to the finish line. And this is of course, a rare moment for all of us to go through a transaction type like this. And we talked a lot about that as a team, that this is something we ought to really relish, cherish, celebrate, pause, and reflect on. And I think that actually added a lot of satisfaction for us. And I know for me, this time around in particular, because we were doing it all remotely. So I'd encourage just that extra level of effort around the fun and celebrating the wins with the broader group.
Yeah, love that. Well, you both have great cultures at your companies, so I mean it was great to see those celebrations, and obviously, as we know and you've shared too, it takes a team, right? It does take a village to get to this point, especially at scale. So kudos to you and your broader teams just for creating that culture and those employee bases that are able to have fun, because it is something certainly to be celebrated. We get to live this quite a bit. You've got these experiences, but people don't realize this is the major leagues of entrepreneurism, right? This is the top group of companies that get to experience this. So that's a well said, JD. All right, so with that, with the remaining few minutes here, we're gonna open it up to Q&A. So again, put that in the chat. I've got one here that I think we'll try and address. I guess, what mechanisms do you use to keep up of the and or ahead of the changing SEC landscape? So as they're making their different initiatives, sometimes even, you know, front running some of their regulations that may come. How are you tracking those? And I guess, how should others be thinking about it? I don't know if one of you wants to go first.
Yeah, I can jump in for sure. This is where we rely a lot on our auditors to bring both to me and my team, the controllership team, but also to audit committee, helping us to proactively communicate, here's things that are being proposed, here are changes that will likely go through, here's questions we have, and I rely on them to help educate us. Obviously, there's other readings and other ways that I keep myself up to speed, but our legal team and external counsel are also very helpful at making sure that they flag things. And we try to be transparent and communicate really often between the teams to make sure that everyone's on the same page and certainly aware of any potential changes or upcoming things that need to happen.
Yeah. JD?
Yeah, same for us. And I would add as well, we added a technical expert to our team in the run up to going public. And that person also has part of her remit to stay abreast of developments and to share them out with the group. And so she does that as well in terms of her own primary research, in addition to the strategies that Lauren talked about.
Yeah, that's smart. So another one we have here, and Lauren, I'll start with you on this one as well, is just, you mentioned before that NerdWallet was looked at a couple different ways as it relates to the sector or even subsector, right? Kind of broader internet. But then as you look at the buckets that you were considered from different, maybe sell-side analysts, how did you kind of select your path, and what were those conversations, and maybe just some advice for companies that are saying, hey, we're kind of between 2 or 3 different buckets, and here's how we manage that, or here's how we chose the path we wanted to go?
Yeah, I actually probably don't have a perfect answer. I think that sometimes it's not very black and white, so don't fret. We, like I had mentioned before, some folks look at us as fintech, some folks look at us as more marketplace or just broader internet. And I think that that's okay. We are pretty clear on comps and who we consider as a peer set. And quite frankly, we have coverage on both sides, which in some ways is actually great. It brings different perspectives to the business when the sell side are writing their reports and doing sort of their valuation analysis. So in some ways it's a positive, but right now we're actually still straddling sort of both buckets. So it wasn't very clear for us.
Okay, that's helpful. And JD, I'm not sure if you had, or specifically for Matterport, but over the years, obviously having done this a few times, what's been your perspective or advice on?
In the Matterport's case, we actually transitioned the business while we were private and are in some ways still doing it today, from a hardware business to a software business delivered on a subscription basis. And so we are trying to work through how people look at us from a business model perspective. And that takes a lot of work. We have to rinse and repeat almost every meeting just to kind of get people refreshed that this is how we're doing, and this is what we're doing, and this is why it's working, and this is the work we have yet to do. So that takes a tremendous amount of time and effort, but I think it's worth it. And we're yielding out now software analyst coverage as well as investors. But I also love the generalist investor too, that is open to mixed model businesses or open to looking at ideas in a different way, or we might be a unique spot inside of their portfolio because they're not overweight software already or completely oriented to software. So there's value in all types of investors, and I think it just puts a little bit of a premium on understanding who we're going to go talk to before we talk to them, so we can kind of talk to their interests and needs. I try not to create a whole new category. That is a tough road to hoe. But at the same time, I don't want to shortchange the uniqueness of the company, in this case, Matterport, because in a lot of ways, Matterport's an N of one. And that, I think, is a sustaining advantage in some ways for us over many, many years. So, it's always about a balance to describe how you're different without trying to convince investors to create a whole new category. So that's kind of how I approach it. And then again, really, trying to be responsive to the type of investor I might be talking to at any given time.
Yeah, well, and I think you nailed it both earlier on. You get to tease this out a bit more when you start to have those conversations earlier in the process, right? You get to share your story, your KPIs as much as you can, and then get that feedback. And at that point, you can not only identify, the different buckets or how somebody views you, but also, is this a relationship that I want? Is this somebody I want on my cap table? And JD, I think you nailed it too. There's, in addition to the specialist, there's the generalist, right? And so it's now well said and a good, again, perspective on it. I guess last question here, and we'll likely run up to it, but another one that came in was, so corporate governance is necessary as early as possible. That's the G now, and ESG is obviously governance. But for you both, is there a critical stage that the company that's kind of planning for this exit must have compliance or really structured governance? And maybe maybe versus a timeline, maybe just share when, from a governance perspective, you also felt that both NerdWallet and Matterport were ready.
Yeah, this was, we rolled this into the broader IPO roadmap. We felt really good about sort of our board and our charters, but obviously we looked also at things like diversity, and we started that process pretty early on. And that was definitely something that our general counsel, external counsel, and our CEO spent a ton of time on. But I would recommend having that lined up, or at least understand if the board or if things are going to change over the next couple quarters, leading up to or after IPO, have all of those conversations early and have at least that roadmap mapped out, make sure people are aligned, so that you can start executing on that pretty seamlessly, and it's not reactive, it's proactive.
Great point.
Yeah, I agree with that as well. And I think it's helpful to explain the requirements too around being public. We had to do that a number of times because they're complicated and they're very different than life as a private company, of course. And so explaining those requirements so that we can take actions well ahead of any transaction date, to Lauren's point, I think is time well spent. And I also think there's a balance too, because early on in the IPO prep process, you might still want to run a lot of private company processes. So metering things in based on your progress, based on your growth and complexity, has value. Not too much process too early, I think, is also a good thing. We ultimately, like Lauren's process, put governance in as a work stream in our preparedness program. And that was spearheaded by the general counsel largely, and then of course overseen by that project manager we talked about. And that just helped us kind of meter things in, be proportionate to the business development and maturity, and then ensure we were ready when the time came to go public.
Oh, well said, and very valuable, not only lessons learned, but just, again, perspective on the right time and when to do this and kind of deploy this. That does kind of conclude our time here. So I want to thank you both for joining us today. This was incredibly insightful. Anytime my eyes darted off is because my fingers were off the home road keys taking some notes. So thank you. And for everybody tuning in, NerdWallet is an incredible place to get any finance, and I even use it on a daily basis, especially with the markets right now, interest rates all over the place. You need any education, it's a great place to go, in addition to obviously the Entrepreneurial Center. And then JD, if you see our build out and a lot of the work we're doing at Nasdaq, all that creative and that digital presence is all Matterport. So it's just been fun to see your work in getting to a public company, but then on the flip side, continuing to execute and have a great product for our consumers. So I invite everybody, nerdwallet.com, matterport.com, check it out. And thank you all for your time today. Colin, I'm going to turn it back over to you.
Jack, thank you so much. And JD and Lauren, really appreciate you sharing those incredible insights from your firsthand experience. So thanks again for joining us. Hopefully everybody found value in that, learning from you. For those of you still on the call, if you're interested in booking a meeting with our partners, please use the link in the chat box to sign up. Before we transition to our last session of the day, achieving success as a new public company, please take this time to take a quick break, take a stretch, and we'll see you back shortly. See you back soon. All righty, welcome back to our final panel of the day, Life as a Public Company. Friendly reminder for those of you on the call, we're going to open up for live Q&A at the end of the session, so please submit the questions for our panel, the Q&A function at the bottom of your screen throughout the presentation. We hope the information provided so far by our experts is timely and valuable, and we look forward to staying in touch as your growth continues. If you're interested in booking a meeting with our partners, please use that link we've been dropping in the chat, and we will throughout the session. Okay, let's now move on to our third and final panel of the day. Without any further delay, please join me in giving a warm welcome to our special guests. We have Allison Beck, who's a partner at KPMG. We have Brian, who's a CFO at GitLab. We have Jane, who's a Senior Vice President of Management and Liability at Woodruff Sawyer. And we have Melissa, who is a partner at Wilson Sonsini. Welcome, team.
Thanks, Colin. I think we can jump right into it. Is that right, Colin, or do you have anything?
That's perfect, Allison. Over
Perfect.
to you, and looking forward to learning more from this discussion. Thanks again.
Thank you, Colin. Well, I'm happy to be back here with you again. I saw a lot of you this morning as we went through preparing for an IPO. Now we're moving on to what to think about after you've gone public. I'm going to be moderating our session. For those of you that didn't meet me earlier, my name's Allison Barr. I'm a partner from KPMG. I work in our private enterprise practice, and I serve a mix of clients, including those that are pre-IPO, those have recently gone public, as well as some of our more established public companies. So happy to be back here with you. I'm going to ask each of our panelists to give us the brief intro. And so perhaps I'll start with you, Brian. Would you like to introduce yourself?
Absolutely. Thank you, Allison. Hi, my name is Brian Robbins. I'm the CFO of GitLab. A lot of people will ask, well, what is GitLab? And just a brief intro on GitLab. We believe every company needs to become a software company to be competitive. With GitLab, you can plan, build, secure, and deploy software in one application with one interface. And so this is a shift from point solutions to GitLab that's similar from a shift from single devices to a smartphone. So remember when you had single devices, you had a Walkman, a camera, a calculator, and then with the integrated platform such as a smartphone, you had everything in one. So we believe GitLab is a smartphone of DevOps.
Great, thanks, Brian, and looking forward to learning from you on this panel. I know you've got a lot of great insight in your CFO role. So perhaps Jane, I'll move to you next. Can you give us your introduction?
Thank you, Allison. I'm Jane Yavro. I'm also a partner at Woodruff Sawyer, and I specialize in management liability insurance, including directors and officers, which I think is most relevant for this group. I've spent about 5 years in the UK as well, and so I specialize in international as well.
Thanks, Jane. And Melissa, over to you.
Hi, I'm Melissa Rick. I'm a corporate and securities partner at Wilson Sonsini. My practice has really specialized in getting companies ready to go public or for kind of a late stage exit. So I work with a number of unicorn companies on prepping for IPO, through IPO, and then post IPO. So really excited to be part of this panel and talk to you today.
Thank you. All right, so we'll dive right into the questions here. So I think we just want to start with maybe the topic of talent. So, success post IPO really hinges on talent, and we all know that there's a war for talent right now. And I know we touched on this in earlier panels as well at different stages of the company. Maybe Brian, I'll start with you. Can you just tell us about how you think about recruiting and retaining your employees in the current environment, including just how you're thinking about hybrid and remote working arrangements and how that might really impact how you think about the composition of your team and how best to recruit and retain your folks?
Absolutely. Thank you, Allison. The good news for GitLab is for over the last 3 years, we've been an all remote company. When the pandemic started, there was no impact to our operations. We have been operating all remote for 10 years. And so we were the largest pre-pandemic all remote company in the world. And so for over 10 years, since the inception of the company, we've never had an office. And so talent, I believe, has recognized over the last couple of years the benefits of being remote, working with more diverse talent, no commute, overall flexibility. And so this has been a real advantage to our recruiting efforts because we're not constrained by geographic constraints in our recruiting. And so we're able to take advantage of talent worldwide, and the ability to work async has greatly helped to retain our talent and for our team members to feel engaged in very diverse activities.
Great, thanks, Brian. We know that talent, it's not only within the company, right? It extends to attracting the right board members. And sometimes the board that got a company to being a public company isn't necessarily the right folks then once you kind of, post becoming public. So, maybe I'll start out with Melissa. What are some tips when it comes to thinking about board refreshment and thinking about recruiting for the board as a public company?
Yeah, that's a great question. So when you're going up into the IPO process, you're going to be looking very closely at who's part of your board. Does it meet the necessary requirements of the SEC and the Securities Exchange, so that you're complying with all those different requirements at the time that you're public. But after you're public, there's going to be probably a little bit of natural turnover on the board, maybe a couple years after you're public. A lot of companies have long-term investors or board members that have just been on the board for a really long time, and they will stay on through the IPO process, but they may not be totally interested in being long-term directors of a public company. So they may be looking to go off. So you're going to be looking to sort of replace those members, and you may just be looking to add additional talent to the board. You'll look around and say, what kind of roles are not represented here? Do we have the right level of diversity? Do we have right members from industry that can help us from kind of just a marketing standpoint or fill different gaps that we have on our board? So, looking kind of at, it's sort of a constant look at, is this the right board right now? And what's the process for recruiting new board members? So a lot of companies do hire outside recruiters to help with this. But a lot of the people around the table are going to be some of your best recruiters as well, in terms of identifying the right talent to fill gaps and going after them and asking them to be part of the board. You'll also have a nominating and governance committee that's a committee of the board that will run this process and will be active when there are kind of those empty spots or spots that you're looking to fill. So this is sort of an ongoing thing, and it's going to be really important, not just when you're going up into the IPO, but in those first few years after your IPO, to making sure that it's still the right group.
And Jane, in your role, it'd be great to get your perspectives on just what you think about in terms of, the composition of the board, as well as, the things to think about in terms of D&O insurance.
Great, thank you. And kind of in lines with what Melissa's comments were, oftentimes the board members, there's a transition when you're a new public company, and you can look at finding new board members, or perhaps what the ideal candidate is, and kind of, from my perspective, in two different ways. One is for an individual who has scaled a company recently. The challenges that fast-growing companies face today are not the same as they were 10 years ago. And particularly when you think of kind of the evolution of the internet and where we're going with, Web 3.0, you need board members with current information. But I think it's also important to find a balance. So then it's also somebody who has survived and has experience with long-running market cycles. So I would say, somebody who's seen another downturn, or perhaps lived through a recession and whatever kind of fluctuations happen in industry specific, getting that good balance can really have an informed perspective. And then kind of building on your opening comments about talent, it's of course hard to find the good board members. You know, Melissa mentioned the folks on the room around the board table will be the best recruiters. That is so true. And it becomes very important to understand for the new directors kind of why the company is the right fit. And so getting those folks involved. And then lastly, once you have a candidate and you're in that offer stage, you know, we want to protect them. They have unlimited liability. So personal indemnification agreements are very important, and along with directors and officers insurance. So being upfront about what type of insurance that the company purchased and the approach has to give those individuals comfort that they can sign on.
Great, thanks, Jane. And maybe Melissa, one follow-up question for you as it relates to board recruitment. You know, I know there are various kind of, you know, rules and regulations these days around the types of people you need on your board. Can you maybe just shed some light on that?
Yeah, so the SEC and the exchanges like Nasdaq and NYSE have requirements on board independence and how many of those directors need to be independent. So when you're going like through the IPO and like if you're looking at new directors, you're going to work with your internal, external legal counsel to make sure that the directors meet those independence requirements if you're needing them to be independent to meet the standards you have to. And then each of the committees that you're going to have, the comp committee, audit, nominating, corporate governance, are also going to have independence requirements. The big topic right now is diversity. So California has, or had, I shouldn't say, diversity requirements. And it was both gender diversity and then unrepresented populations. There were separate laws that were passed. Those are right now were overturned in the court system. We're not really sure how that's all going to play out, but they were in place long enough to really have an impact from my perspective on board composition that we're seeing from our clients in California. And we think those are going to have lasting impacts. And I think what a lot of our companies would say is they saw that, you know, they were recruiting and including diversity requirements in what they were looking at for new board members. But they were also kind of getting that feedback to do that, not just from the California rules but also from investors and other stakeholders to consider those requirements as part of the board recruitment process. The Nasdaq also has diversity requirements. So if you list on certain exchanges, the NYSE doesn't yet, but they maybe at some point they'll put those in place too. So there's multiple things you have to consider from a legal perspective, when you're looking at the overall composition of your board to make sure you're meeting all those requirements as a public company, both when you go public, but also for maintaining that, you know, as you're refreshing your board members over time. So it's something I'm not going to go into detail on what exactly those specific requirements are, but just know they're out there and they're things you need to take into mind when you're recruiting board members.
Great, thank you. Maybe shifting topics a little bit. So being a public company really calls for a lot of increased transparency, clearly related to the financial information. There's a lot of increased transparency, but there is also a lot of increased transparency requirements related to things like cyber incidents and ESG, and of course there's the new climate proposal and you know, requirements related to even things like diversity and whatnot. So maybe Brian, I'll start with you. You know, as you've just interacted with institutional investors and analysts, you know, both during the IPO, post IPO, you know, were there any topics you wish you were really better prepared to speak to?
Thanks. I really appreciate this question. You know, GitLab aims to be the most transparent public company that there is. And so the transparency really helped us educating investors and eliminating any surprise questions. You know, one of our 6 core values at the company, we have credit values. The T stands for transparency. we have a handbook with over 2,000 pages that anyone can access. Prior to being public, everyone on the call had access to about 95% of the information that I had access to. And so as a public company, we actually had the opposite challenge around transparency. We had to say, how do we continue to remain very transparent and not share material non-public information? And so we found that our transparency was not only good for team members, but was very helpful during the IPO process and being public. As we led up to the IPO, we did a number of non-deal roadshows. This was also very helpful in building the relationships, the credibility, and familiarity with GitLab. And so if anybody wants to look at the handbook, the easiest way, just go on Google, type in GitLab handbook, and then type a topic. And we have over 2,000 pages on all the company policies. We used to put vendor reviews on there. We have our 10-year roadmap on there, OKRs, anything you want is really found on our website.
Wow. That's great. I think, it is a challenge moving to that world of all of a sudden your information becoming public is regulated. So I'm sure that was a challenge, but also an opportunity. Melissa, maybe shifting over to you, obviously there's all these new rules related to, or I guess I should say proposed rules related to cyber reporting, as well as the SEC's proposal on climate disclosures. And there's a lot to absorb there. And I guess none of us know exactly where those are going to land in terms of what the rules will end up being. But I think it's clear that there will be rules. And so, when should a new public company really start taking on some of those initiatives related to things like ESG and cyber, and how should they really think about, what they report to the public and the timing of that?
Yeah, when you should start thinking about this is before you even go public, especially with some of the new rules. It's something you might end up having to disclose in your initial registration statements, your initial disclosure when you're going through the IPO process. So it's not one of those things you're going to want to figure out then. I think when making these determinations on how you're going to report it and what you're going to do in terms of like ESG or some of the cyber disclosure, you really want to find things that you can measure, that you can actually report on, figure out who's going to be responsible for these internally. And I also like to think, like, not a legal requirement, but that whatever you do decide to do along these lines, that it's sincere. The stakeholders here are not just the investing public, but they're also your employees. We're seeing that a lot of people really care about what the company is doing in terms of ESG. So there's other stakeholders involved, your customers, if you're consumer facing, especially they're going to care about what you're doing, and the people you're partnering with too. These are things that we're seeing increasing among our clients, that they're getting questions from all these different stakeholder groups on what they're doing with respect to ESG. So it's something to start, I wouldn't say for every company, like this is the first thing you should do, but if you're thinking about going public, it's something that should be on the list of action items to start addressing and finding those people internally who can report on this, report accurately and timely.
Thanks, Melissa. I guess, Jane, from the insurer perspective, how do you think, the insurers think about things like ESG and diversity, equity, inclusion, and social matters?
Absolutely. So, no insurer wants to see their clients in the news for getting ESG wrong. I particularly like what Melissa said about sincerity. I think that is kind of, if there was a theme, that runs through it, doing the right thing and being sincere about it, meaning you're also taking action on what you say you're going to do, can be very helpful. Having DEI, but by the time you get to being a newly public company, it's table stakes. There should already be a framework in place. What can be challenging for new public companies, however, is if you're going to take a position on some of the current social issues. So you can see where kind of employees kind of demand corporate participation in some of the hot topics. And it may be that the board doesn't want to be so open and public about that. I think it goes back to having seasoned board members, a strong management team, people who understand the company's culture and can guide them to a kind of balanced approach that satisfies, kind of all stakeholders.
Thanks, Jane. And maybe, Brian, a question for you on this topic. I mean, just from an SEC issuer point of view, I mean, how much effort, how much time, are you guys putting into kind of figuring out what you want to disclose, what you need to disclose, and the effort it will take to do that?
Yeah, I have to give thanks to our amazing legal team. And so, they undertook the effort to basically go through the entire handbook. We still live stream a lot of our meetings. And so if you want to, go on YouTube, you can see a lot of the meetings that we have that we live stream, within the company, our key review meetings and so forth. And so there's been a lot of effort to go through and understand what can be published and what can't be published. But we ask ourselves constantly, why can't we share that? And as long as it's, not material, non-public information, we lean on the side of actually sharing it. And so, since we're an open source project and, we have a big open source wider community, we think it's really important that everyone can contribute and to include everyone and sort of some of the decision-making processes and the information of the company. We found that to be very beneficial during our D&O policy, getting our policy to become a public company, because all the underwriters had so much information on the company. And we did have a concern internally that it potentially could lead to so many questions. And every one of them, when we had our meetings with them, was extremely thankful for how transparent we were, that they could see everything on the company, and the meetings were very, very efficient.
Great, thanks, Brian. So now maybe shifting topics one more time. So, the completion of an IPO is really just kind of the start of the next part of the journey, right? So maybe starting with you, Melissa, as a corporate and securities lawyer, you're involved with companies both before and after they go public. So can you maybe just share some thoughts of, what to do, what not to do, lessons learned as a new public company, and just any practical suggestions for those newly public companies?
Yeah, there's a lot.
Yeah.
Yeah, Brian's living through it. So I think in terms of like some, I think it's a little drinking through the fire hose a little bit the first time you're sort of going through the reporting cycle, making sure everything's in place. A lot of this work does start pre-IPO, but that first year is kind of, making sure you are doing it right, because a lot of this gets rinsed and repeated after the first few earnings cycles. So that first, one you're doing, first couple you're doing are really important, because it is setting the tone for, how you're going to process it in the future. And they do take a lot of time. So I think just having that realization too, like this is going to be a big effort, a big expense that we just didn't have before, which I think companies, when they go public, they realize it. But maybe Brian can say if there was any surprises there on just how much extra work and distractions from the team. Building out your finance unit is really important. Again, a lot of that happens pre-IPO, but there are people that get added often later to just help with the reporting that you're going to need to do. You'll have a dedicated team to help with that.
Great. Brian, I guess, in your CFO role, what were you particularly focused on in the first year now, post IPO? I'm sure, I have to imagine there's a lot of things you're really focused on leading up to that IPO. I guess once you go through that process, you're public, you're trading, you now got your quarterly reporting and everything. What is top of mind for you? What are the highest priorities?
Yeah. I think the first thing is really to continue to drive the mission of the CFO organization. And so the mission statement within the CFO organization is deliver timely and accurate financial information to enable optimal decision-making to increase shareholder value. And you do that in sort of every element. And so I guess, within the first year, I'd break it down into external activities and internal activities. Externally, one of the big changes is the number of meetings you have with buy-side investors. And so in our first open window, I had probably about 75 meetings with buy-side investors, and second was over 100 meetings. And so I'm aiming to have between 100 and 125 meetings during our open window. There's a big quiet period leading up to the IPO and during the quarter. And so, there's definitely a void that needs to be filled around messaging and telling the story and so forth. Internally, I really think it's almost like a continuation of the IPO readiness programs that you ran leading up to the IPO. And I think it's important to talk to your team about it being a marathon and not a sprint, because sometimes it feels like a sprint and you're running just as fast as you can. And I guess I would just say the focus areas internally has been, reduce the close time, quarterly reviews with the auditors, streamlining the earnings prep, continuing to drive more automation within the business, implementation of Sarbanes-Oxley, career development, mentoring team members, recruiting new team members, enhance business analytics capabilities, and continue to refine the predictive models. And I think most importantly, continue to drive and maintain the culture of the company. Those are the things really that, I've been focused on really in the CFO organization to drive the mission of providing that accurate financial information to enable the decision-making within the company to drive shareholder value.
Yeah, that's a lot. You listed a lot of things that need to be done after going public. I think that's right. I know one of the questions that I get a lot with my clients is, obviously you're preparing for this IPO. And in that process, certainly you're not complying with things like Sarbanes-Oxley at that point, but I think it's in the back of everybody's minds, right? They're like, okay, I need to be thinking about processes, be thinking about controls, be thinking about how to, get all these systems working together in the right way. And obviously, from your point of view as a CFO, you want to feel comfortable that you're getting that high quality financial information before you put it out to the public. So how have you guys been thinking about, moving towards a company that will have to be SOX compliant at some point, probably pretty soon? Just how do you think about getting ready for that? I imagine you don't flip a switch overnight.
Absolutely. It's writing numerous S1s and going through this process a couple different times. I always say that, it's, practice as if you are public, that, you're never fully ready to go public. It's just the amount of risks that you want to take while going public. And so you should at least have, 2 quarters of acting like a public company. We did mock earnings calls. We did Q&A with, external advisors who would ask us about stuff. Prior to our quiet period, we did a lot of non-deal roadshows with investors to prepare for the type of questions that we'd get and to check our investor materials to make sure that the messaging was clear, the metrics were right, what metrics we chose weren't too much, they weren't too little. I think the other thing is, it's just really important just to be organized. We organized our IPO readiness around, 16 very discrete work streams and assigned to each owner over a very big cross-functional group. And that was from guidance to revenue recognition, to IT compliance, to governance, to marketing. And so it's important that it's very cross-functional, any contributions from everybody to actually make it successful. And then I guess, finally, there's a lot of work, in doing that. But the most important thing is to keep the group working on the IPO as separate as possible from the business, so you don't actually distract the business during the process. And, at the end of the day, going public is really just the entry point. Being a public company is about, continuing to deliver the results and having predictability around the business.
Right. Jane, just thinking from the insurance perspective, once you've completed that IPO, what do you think are the most important things to think about post-IPO?
Yeah, thanks, Allison. So Sarbanes-Oxley is a big deal, and being open and transparent. Brian seems like the poster child for all the things that you should have in mind. So thank you for noting those topics. The insurance underwriters will want to understand where you are on that journey and the steps to be Sarbanes-Oxley kind of fully compliant. I think in the current marketplace, though, it's a little bit interesting because many of the IPO companies are trading below their offering price. And so that we're going to see kind of some challenges in the next 12 months, I would imagine. It's good to remember that even the best companies can run into choppy waters. And I would say the important thing from my perspective is to keep your D&O insurance in place no matter what, or you risk losing those board members that you worked so hard to recruit. You know, a communication with the D&O underwriters, treating them as a partner, those are all really valuable. I would also want to mention that cyber insurance can be something that is top of mind, both because of the proposed SEC rules and also simply because it's a more challenging marketplace right now. We're seeing a higher frequency of cyber events. So it's kind of D&O plus cyber, I think, would be the next kind of phase.
Great. So now maybe just moving on to some, you know, kind of ad hoc topics here. Brian, you know, I think we get this question quite a bit in the accounting world, and there's a lot of, I'll call it regulation and work that goes into being a public company. So how do you kind of think about, you know, the burden of being a public company on your time and on your team's time? And how do you kind of balance that with, you know, just enhancing the finance and accounting organization and you know, not getting caught up too much in it, what's might be viewed as administrative tasks?
Yeah, good question. You know, I would flip it a little and say, you know, it's a privilege versus a burden to be a public company for, you know, so many investors to, you know, buy into your company and the story and the stock. And yeah, I would just say that you know, it's really important to have the right team in place and to start early in hiring the key positions. And so even though Sarbanes-Oxley isn't required, you know, based on your size and filing size, so it's a certain time, you know, it's important to start it early and get the right people on. So, you know, because you're still personally certifying the financial statements. It's great to build out your accounting team and make sure that you have all your rev rec well documented. And so I would say the team is really the biggest element. From, you know, the CFO perspective, you know, you probably spend about 50% of your time externally, you know, in all the meetings that you have with investors, you know, the audit committee meetings, getting ready for the earnings call, doing all the prep for earnings and so forth. And so, you know, especially in these markets today, just listening to all the various earnings calls and seeing what the questions that are being asked and understanding, you know, where the concerns are of the investors and, you know, how you work that into your script and, you know, what impact that may have on your business operations, I think is important. And so there's a lot more time just sort of understanding the macro, you know, as it relates to how it will impact your business and how you'll convey that message.
Great. And maybe along those same lines, I mean, you know, once the company became public and all of a sudden you're now, you know, operating in this world with, you know, deadlines and, you know, having to get things on file with the SEC, what do you think the biggest surprises were for you and your team? I mean, I know you've been an experienced CFO of public companies before, but any big surprises for your team in terms of like, now we're public and now we got to do all these things and how do we get it done?
You know, I would go back to what I said earlier, is the whole practice makes perfect. And so we had 2 quarters of practice prior to being public where we actually went and drafted the entire 10Q. And so, you know, it seems like a lot of work, and it was, because people have their day jobs as well. And so, you know, I think the surprises were early learnings of, you know, making sure that there was a extremely well documented plan You understand who the DRI is for each process, and understanding interdependencies that each of these functions have on one another to actually reach what you need to reach to deliver, a successful earnings call and messaging to the street. And so I think it's, really goes back to, prepare early, practice. I think where a lot of companies make the mistake is they start too late and then they want to rush it. And then they think that they can get it done, but then they get out way too early. And there's lots of ways to go public these days. And then they're, sort of in the public eye, they're trying to correct certain things or understand what their long-term strategy is or their long-term financial model. And so I think starting early, all the practice, having the right team, and sort of running those cadences is extremely helpful.
Yeah, it's interesting as I work with many of my own clients, sometimes I'll have discussions with them and they'll tell me, oh, we got our close process down to, 10 days or 12 days and we're proud of that. And we start talking about it and I try to understand, well, what do you mean by being closed in 10 days? Like, what does that mean to you? What is done versus what is not done? And it's interesting how, especially with the private companies where, monthly reporting, quarterly reporting isn't necessarily, done at a very detailed level. I'll start to learn things like, oh, well, we didn't book our stock comp charge, or we didn't really look at income taxes, or maybe we didn't finish all the reconciliations. And, you start to drill down into that and find that that 10-day close might not really be the equivalent of a 10-day close, like if you were operating as a public company. So I think that's something to keep in mind for people is, when you're trying to kind of measure that close period for your books and figure out if you can really get it done. I mean, the tips Brian gave about kind of doing the real dry run, writing the real 10Q, doing the kind of fake earnings release, all those things really need to be done in order to be a public company. And so until you kind of try to do it yourself, you won't know if you can accomplish it. So I think that's really important. And if companies have the chance to do, 1 or 2 dry runs, that's kind of the ideal situation.
Great advice. Completely agree.
Now, Jane, in one of the earlier panels, when we were talking about D&O insurance, more from a pre-IPO perspective and going through the IPO itself, we talked a bit about how that insurance is very high. So when does the cost of D&O insurance start to go down post-IPO? And is there anything companies can do to think about how to save money on insurance?
Yes, this is a hot topic these days. For companies that went public recently, were buying basically at the peak of the hard market, meaning capacity was very restrained for insurance. It was very expensive with very high retention. The good news is that those companies are renewing in a more favorable marketplace. So we are seeing for companies that have a good risk profile, significant premium decreases, and in some cases actually being able to reduce the retention, that self-insured retention. We think of the IPO penalty box as aligning with the liability from the S1, so that's a 3-year period. So 3 years from the IPO, there's a natural drop off in premium. That being said, that's being brought forward in the current marketplace because the conditions are favorable. So there's finally some good news in D&O insurance. And I'll echo the comments about the mock Ks and Qs. That is something that can position a private company in a much more favorable position with the underwriters when you can demonstrate that you've done these mock filings. Underwriters love that.
Great. And Melissa, I know in your role, as SEC counsel, when you work with companies through an IPO process, that looks a little bit different than when you work with companies post IPO. So maybe you can just share a little bit about what the different roles are and what the legal needs really are, going through the IPO versus now that you're a public company.
Yeah, going through the IPO or becoming a public company is is a different process. And I think there's a lot that goes into changing yourself from a private company into a public company. And it's not just the SEC process. You know, throughout that, you're going to be revising probably a lot of your internal policies, a lot of the items that Brian mentioned that they did which weren't involved with like the actual legal status of being a private or public. You know, you're going to be looking at your marketing team, your communications, kind of employee matters. All these things are part of the process. And then there's just the mentality too. Like, you're suddenly going to have employees who are looking at your stock price all the time, you know, or outside parties who are focused on your stock price, who, you know, you never had that. You got to kind of stay under the radar to some extent while you're a private company and grow and make decisions without as much scrutiny as you're going to have when you're a public company on a number of fronts. So those are all like really significant changes that some of them are legal, some of them aren't legal. In terms of the legal parts of it, going through that transition or transformation from becoming private to public, the legal team, both internal and external, are going to be really involved in revising, renewing, refreshing, or even creating new policies, procedures, making sure that you have all the appropriate things in place, a lot of which you may have as a private company, but maybe you haven't checked all the boxes. Like, you know, a lot of companies are moving quickly. I think we really saw a lot of lack of maybe pre-planning in this last like IPO cycle last year, where a lot of companies kind of had the opportunity to go public through SPACs or other means that weren't planning to go public. They had to do all this like really quickly. So it can be done quickly, but it's really nice if you build that time in to do it thoughtfully and to do it over time with your legal teams, with your finance teams. So it's not like you're really trying to turn a light switch on overnight, which is complicated and it just is hard to do. It's better if you can extend it over time, looking towards that 18, 24 months before you go public. That didn't happen for a lot of companies last year. It's not that you have to have that time, but it's really nice to have, and it will make sure things actually are in place, that they work the way they're supposed to. And so there's a lot of work that goes into that pre-IPO. Post-IPO, you're going to continue to refine things. You're going to find certain things don't work the way you want them to, or the company is a little bit more mature. It doesn't need some of the legal policies the way they were drafted at the time you went public. Now that they're getting like put into practice a little bit more, you're going to continue to refine them. And you'll be working with your board on a lot of these matters and legal counsel to say like, okay, does, you know, our insider trading policy, the way that's drafted, does that really make sense for us still 2 years after we're public? Like, what kind of changes do we want to make to that? What changes do we make to our code of conduct? So these are documents that will continue to be revised throughout the life cycle of you being public, but won't be, you know, on as quick of a basis, I guess, like in the pre-IPO. Post-IPO, you'll review them and you make no changes or maybe a couple changes the year to like all your policies. So it, you know, a lot of this continues to go on. One thing I'll say is, for a lot of the companies we work with as outside counsel, we tend to be like really in the weeds pre-IPO, during the IPO process, in part because your internal legal function may not be as built out as it is when you're post-IPO. So one thing that I do see change over time with a lot of our clients is that they hire more internal lawyers who can do the reporting, who can handle a lot of this, and rely less and less on outside counsel for more of the day-to-day work. So that's also a shift that we see.
Great. Now I know we're going to take some questions live soon. So if anybody has any questions they want to drop into the Q&A section, then please do. But before we get to that, I am going to ask each of our panelists to maybe give us one key takeaway. I know that's really broad, but just thinking about first year as a public company. Jane, I'll start with you. What is the number one key takeaway you have for the group?
That it's an evolution, that you need to continue, review, and refine, and work with partners to get to where you're going.
Great. And Melissa, I'll ask you the same.
Yeah, I think a common theme that's come up in this discussion is, put the practice in on some of these things before you go public. It'll make it a lot easier for you once you're public to already have some of that muscle memory built.
And now, Brian, I'll turn it to you with the same question.
Thanks. Echo what some of my co-panelists said as well. But yeah, I believe start early, focus on the team, and have the right culture. And what I mean by having the right culture is I always tell my team surprises are only good at birthdays and holidays, not during work. And so, predictability is really key. And so have people come talk to you quickly and have the forums where you can raise questions or concerns about either people, processes, or platforms super quick so you can address them.
Great. Now, one question did come into the chat that I'm going to ask you, Brian. The question is, how crucial is it to have a CFO with public company reporting experience through the IPO and in year one versus having a CFO that might not have that experience and is in the process of learning it?
Yeah, I mean, I've heard a lot of different viewpoints on this, but I really believe that being a public company, there's a lot around credibility and relationships with the sell side analyst. And so if you're in a vertical and you've been covered before as a public company CFO, and you're sort of a known quantity based on how you operate and the messages that you've delivered and the quarter after quarter of repetition is super, super important. And so if you haven't taken a company public, I personally feel that that's okay, because you're going to lean really heavily on your legal team and outside legal counsel, as well as your auditors and your other advisors, but really understanding what message to convey, how you've operated historically, and how you conduct those earnings calls, I think is really important in the early days of being a public company.
Great. And maybe, one follow on to that I know people really spend a lot of time on in the IPO and even post IPO as a public company is, I mean, when you think about, what metrics you want to present to the public as being, kind of how you're measuring your business, I mean, maybe just shed some light on like how much effort goes into figuring that out, because I know that that's not an easy process to figure out exactly what you're going to present and how to get the information to present it, and the kind of the details of how you come up with some of those numbers, whether they're operating metrics, non-GAAP metrics, et cetera.
Yeah, 100%. And really good question. The first thing you do as a CFO when you go into any company is go validate the data and the definitions. And so, there's 100 different ways to interpret metrics, and you don't want to be a company that has vanity metrics that aren't used by your peers. And so the first thing I come in is look at the data of how it's being pulled and how the metrics are defined. Then you go do a pretty exhaustive benchmarking exercise and look at the benchmarks of your competitors and your peers in that vertical. Then you look at your long-range model and understand how those metrics are going to, how they look over time and your predictability around those metrics. And then you come up with the decision on what are the best metrics to give the best insight to investors to make a decision on the progress the company is making and forward looking at what you think that the company can do.
Great. Colin, any more questions that we wanted to field?
Y'all have covered so much, and it's amazing. And for those of you still on, if you have any questions, please drop them into the Q&A function at the bottom of the screen. Let's see, there's a question that just came in. Do you have any sort of targeting pre-IPO outside of what the banks gave you?
And is it
targeting? Yeah, did you do any sort of targeting pre-IPO outside of what the banks gave you? I'm guessing.
Yeah, And so there's a lot of targeting. There's investor targeting. There's financial targeting. From an investor perspective, we did an offering on Nasdaq private market, and so we had a lot of institutional investors that came in early, and those were selected based on who they've held, how often they hold, their relationship with management teams historically. From a financial and metric perspective, the banks did give us some data and they're great during the process, but a lot of that I encourage the teams to do internally and to come up with their own numbers so they really understand, the variability around those numbers and what numbers you should provide.
Amazing. Thank you for sharing that. And Melissa, Allison, Jane, we talked about this a little bit in our first panel, but would love to hear if you have any differing perspectives on advice around the roadshow.
Yeah, I can jump in there. So the roadshow, meaning for the group here, what we're talking about is going out to investors and selling the securities as part of the IPO. It's like a coordinated effort with your bankers, with your legal team, and with the company. One change that happened since I've been practicing, I'm not sure how long ago it was, is the SEC allows us to go out and do what's called testing the waters meetings. So what that means is you can go out to investors before you're actually selling the securities and give them your presentation on your business. When this first came out, people weren't really sure if companies would take advantage of it, but I would say all my companies that do IPOs do number of testing the waters meetings. And especially if the IPO gets delayed for any reason, if it's like the current market dynamics or something specific to the business or the industry, companies will refresh those meetings. They'll go back to those investors, say, hey, here's what's new in our business. And I think companies have found that process to be able to do testing the waters meetings, which look pretty similar to your roadshow, before you're actually going to investors during the roadshow and asking them to buy the shares, is really helpful, because once you get around to them at the roadshow process, they already know your story, you're giving them an update, and it's impactful that way. One thing that's also gotten popular in terms of roadshows, and Brian, I assume you guys maybe did this, it'll be interesting to hear, is to do a video. And these have become especially for any kind of consumer facing business, high production, very expensive, professionally done videos. So that's one of the things that, we used to literally when I started practicing, the roadshow video was the CEO and the CFO standing in front of a PowerPoint presentation, and that was recorded. That was your video. It's a whole other world now. So working really closely with your marketing team on that roadshow video, the messaging, the graphics, everything, it is a kind of a new process, but an important one as well.
Great insights there. Allison, Jane, anything to add?
No, I think Melissa summarized it well.
Love the exhibition match concept. Very timely question for the panel. If a company has a solid balance sheet and is strong in a strong sector where multiples are still very high, is there an advantage to go public when no one else is? You get more attention, spotlight, question mark.
Yeah, I don't know. You probably would get more attention just by virtue of being one of the only ones going out. I can tell you over the past, probably year or two, it's been so interesting, during the day when I look at LinkedIn, it seemed like there was a period of time where almost every day I had a friend at one company or another that was saying, oh, we went public today. And there have been such a high volume of them. Obviously that's slowed down now. I think every company thinks of this a little bit differently though. Some of them are racing to go public, others, that isn't as high of a priority. But to your point about if we've got a solid balance sheet, I think during this point in time, that's really important. Just having that solid balance sheet, making sure that you have the cash on hand, because the reality is it might take a little bit longer to go public right now because of the market conditions. So that's, my perspective on that, but it is an interesting question.
Yeah.
I
I would add, oh, go ahead, Brian.
Yeah, I get, so writing a couple S1s and take a couple companies public, I guess my viewpoint on this is, one, there's a lot of investors have charters of how much they can invest in certain industry verticals and sectors and so forth. And so if you're second, third, or fourth to go public, you may limit the amount of people that can invest in your company. If there's no one in that sector, or there's a close competitor and you and that competitor are looking to go public relatively at the same time, you're either going to lead the story and tell about your story, your financials, your multiples, and what's going on, or you're actually going to answer to how your story is different than their story. And so, I would always encourage companies to choose to go public when they're ready. I wouldn't rush that process to try to beat someone out. But all things equal, if you have a really strong company with really positive metrics, I think being the first company out or beating a competitor out, I always like to tell the story, then answer how we're different than the story that's already been told.
Yeah, I agree with that. I would just say, I would wonder why aren't the other companies going public? If it's for external reasons, there just isn't the investor interest right now, or the investor demand for IPOs or companies in that industry, or whatever it is. That's one thing, but there's a lot to be said about, beating out competitors. I like to think of kind of the timing of Uber and Lyft going public, right? Kind of that race to be the first one out, and tell that story, and also, a lot of the marketing around it and the legitimacy that you get from being a public company, compared to your competitors. There's also a piece of it too, where if your competitors aren't public and you are, to think about how that's going to impact, either from a positive perspective or a negative perspective, your ability to recruit and retain employees who are going to have a little bit more liquidity in their stock, their equity compensation once you're public, which is great if your stock price is going up.
That's great advice. We may have time for one last question. Brian, I'm going to pose this one to you in case you have dealt with this, but I'm going to ask Melissa, Jane, or Allison to chime in if this has come across your desk. But question from an attendee: how do you avoid getting takeover offers after submitting your S1 and make sure you get public?
Yeah, I don't think there's any way to avoid it per se. Most people file confidentially under the Jobs Act. And then when you become effective, there's a very short time frame for when you become public. And I think from a board governance standpoint, having takeover provisions and certain things in your bylaws is the most probably the best way to have offers that aren't taken to fruition, if you will. But if your information's out in the public, and if someone thinks you're valuable and wants to take you off the market, it's your fiduciary duty to the shareholders to basically take that offer to the board and entertain the merits of the offer.
Any other points to that?
Yeah, I agree. It's not, there's a lot of things, we call them defensive measures on the legal perspective, that we put into place when companies go public to help them defend against hostile takeover situations. You can't really prevent it, someone indicating their interest, but you can kind of prevent a lot of it, or get them to come to the table, to negotiate. I think what's top of mind for everyone is sort of the Twitter situation now. In terms of the IPO, yeah, it's really true that a lot, until right before you go public, the people may not know that you're going public. But I have sold 3 companies between when they flipped public and they priced. And those were in the company, it wasn't hostile situations. It was just, I think, really good acquirers saying, oh, they're really going to do this, let's put an offer in. And it was very everyone was super happy in those situations, on both sides. So, we do see, once you're kind of out there, they can see more information about you. You may get inbound interest on buying the company.
That's great advice. Well, we are at time. Allison, Melissa, Brian, Jane, thank you so much for joining us today to share your real world advice on life as a public company, but so much more. Really appreciate you joining us. And for everybody still on, hopefully this was insightful and helpful for you as you think about life as a public company. So Allison, Melissa, Brian, Jane, thank you so much. Really appreciate it.
Thank you.
We'd love your feedback for those of you still on. So if you're interested in meeting with our partners or giving us some feedback on this program, please take a moment to fill out the survey in the chat box. We hope to be able to follow up with our partners with you soon. In case you missed any of the sessions today or would like to rewatch the videos, and the content will be available on our YouTube page for on-demand viewing. And you can also use the link in the chat to subscribe to all the great content we've got coming out of the center. From everyone on the Nasdaq Entrepreneurial Center team, thank you all for joining us today, and we look forward to welcoming you back online soon. Have a good one, everyone.